Why don't we start with introducing ourselves, right? So for those people that are listening, first of all, thanks for tuning into this podcast and thanks for listening. I hope that you subscribe. We're sitting down with two of the captains of industry, right? So since the beginning of time, since I've been in this game, I got out of the Navy in 2000 and stumbled into this space on accident. And right around then was right around the same time that you guys, who probably didn't even know each other at that time, were building what was now, it was a David versus Goliath model in data centers, two completely different products, wholesale, retail, right? And let's go a little bit into the beginning. Who are you guys and where are you guys from? Bill, you want to go first?
I'm sure. I'm from Pittsburgh, Pennsylvania, originally, and started out was a lawyer. First of all, in the prosecutor's office in Pittsburgh, and then as a civil litigation lawyer, that's an oxymoron, I suppose, and then ended up doing securities and finance deals, and flipped over to do the financings themselves as a business guy with the electric utility in Pittsburgh, where I was treasurer. And from there, I moved to Westinghouse Electric, first Westinghouse Credit, which was their financial services sub, and then to Westinghouse Electric, the large seller of electrical gear. From there, I went to, I had a client at Westinghouse Credit called the Scheidler Group. And Scheidler took one of their portfolio companies public called TriNet Corporate Realty Trust. Jay Scheidler was the patriarch of the whole business. They were a client of mine at the Credit Corp, and they asked me to go out to San Francisco to be initially their CFO, and I ended up eventually as president. At TriNet, I got to know the investment banker who took TriNet public, a fellow by the name of Rick Magnuson. And Magnuson was a banker at Merrill Lynch at the time. Rick ended up eventually founding a firm called GI Partners.
Okay. Everybody knows who that company is.
And it was through a long-standing relationship with Rick that began in 95, 96, that in 2002 or 3, maybe it was 3, he had at that point acquired several data centers through a joint venture that he had, in essence, had formed with CalPERS and CB Richard Ellis Investor. He was planning to take it public and asked me to come on board to help take it public. This was in late 2003.
Had you taken companies public again? I'm sorry if I missed in the first part with Westinghouse.
No, I'd never taken one public. I was the CFO of a public company in San Francisco, and then the president. That was TriNet, so it was a REIT, and he was planning to take it public as a REIT. And basically, we traveled in the same REIT circles, and as he was thinking about taking it public, he was told by a number of his investment banker financial advisors that he needed to get somebody on board that knew something about the REIT public markets and had been there before. And I knew Rick, and it was an easy connection for the two of us to make. And I remember having lunch or breakfast with him actually at a place down in Woodside, and that's when he sort of sprung the idea on me. I actually was, at that time, I was doing workouts for private equity firms in Silicon Valley.
You like a hired gun?
Yeah, I was a hired gun. I was doing work for the PE firms down there, and I went to see Rick to solicit business. And he said he didn't have any portfolio companies that needed workout help, but that he had this portfolio of data centers that he might want to take public, and asked me if I wanted to help him do it. And I said, sure, call me when you're ready. And he did. It was like November of 2003 when he finally called, and I officially joined as a consultant in March of 2003. And we got it through the IPO window in November. And March 2004 was when I officially joined, and November of 2004 was when we got it through the IPO window. And I mean, interesting history that data centers were, a four-letter word in a sense. Nobody in the public equity markets wanted to touch these things in 2004. So we had a hard time getting this thing public. I still remember our IPO price range was $14 to $16, and none of the REIT investors in the Northeast would touch it in New York City or Boston because they'd been burned on
the asset class that didn't exist, basically.
Well, and I mean, basically, the .com guys had all gone bankrupt, and those were the credits that went bankrupt, and so the assets themselves were in trouble, and so these guys the REIT investors didn't want it, but at least in the Northeast, we started selling the deal out in Chicago. So Reef was a huge buyer. KG Redding was a big buyer. And then finally, when we got to the West Coast, Franklin and San Mateo put in an order for 15% of the deal. The guys at Keeney Anderson down in LA put in a big order, so that the deal happened on the West Coast because they understood the credits and they understand the thesis. They were looking forward, and unfortunately, the guys in the Northeast were looking in the rearview mirror, I think.
Were there any publicly traded mission critical REITs at the time that Digital was trying to do that?
There weren't any REITs. Equinix was public, but it was organized as a C Corp.
Yeah.
That was it, I think, Dave. I don't think there were any other public ones at that time.
No, I think people were thinking about infrastructure. I think there was these towers that were, of course,
But like CoreSite wasn't up?
No.
Okay.
No. It was.
I got you.
It was
CoreSite
Equinix
was owned by Carlyle at the time.
Yeah.
We actually brought a couple of guys over from that CRG West portfolio. Chris Crosby, who worked for CRG West, came on board to lead sales at Digital, and Jim Trout, who was also at CRG West, came on board to sort of head the asset management team.
So it's funny because we're going to go back to that. And we'll introduce you, Dave, a little bit, to put a pin on his side, because you probably haven't listened to some of the podcasts, but there's conversations I've had even with Chris telling his story. He gave that side of the story.
Chris Crosby.
Yeah. And one of the things I said was, I don't know. I mean, you guys tell me, is there any group that doesn't have an alumni member of Digital Realty Trust in their C-suite in the industry today?
Today? Yeah, I'm sure. Like, I don't know if Iron Mountain has anybody.
Oh, really? Okay, so there's not many is what I'm saying. I mean,
yeah, but they did. They did. So, but people rotated through there.
It seemed like when I was growing up,
Equinix too. I don't think Equinix. Yeah.
Well,
Equinix doesn't really hire digital people.
Yeah, yes, there was a little bit of rivalry between those. My thing was, from the outside looking in, there was this big company that was Digital Realty Trust that was already public, because you guys did it in 2003, 2004?
Late 2004.
Okay. So, and you guys were the Island of Misfit Toys that were growing, right? And I was doing work with you guys. So, Dave, introduce yourself to anybody that's not listening and hasn't tuned in yet.
All right. Dave Ferdman. I was the founder of CyrusOne. Prior to CyrusOne, I was in the telecom business. So where Bill comes really from the real estate background. And as we talk, you'll realize, like, Digital grew up as a real estate company.
Oh, completely different.
And Cyrus grew up as a service provider, like I wouldn't say technology service provider, but almost like just a typical service provider that was not signing leases and thinking about the real estate side. In fact, we didn't even want to own the real estate. But back before I was in the data center business, and how I got to the data center business, I was in the telecom business. The group of buddies.
Where are you from? Are you from Texas?
I grew up in St. Louis.
Okay.
So St. Louis, Midwest, my entire life. Went to school at Kansas University. I'm a Jayhawk. Went to work directly out of school in the wine business. Actually, worked at for the Gala Winery. They put me in Kansas City and Chicago, and they trained me basically on how do you build sales teams. When Cyrus came out of the gate, we were a sales-focused organic grower. So everything about the company was based on how do you grow an organic sales team and go build market share. But before we got to Cyrus, 1992, I joined some college friends, and we built a telecom company from the ground up. This company was officially a reseller, first switchless and switch-based reseller of the main fiber providers, primarily Sprint. And we put, we effectively built a market around trade associations. So what we did is we went to the trade groups in Washington, D.C., primarily groups that were industry lobby groups, and we'd say, hey, you can do something for your entire industry, and we'd wrap a telecom product around that, and then they sold that as a benefit. We grew that business to about a $35 million business organically, and then we merged with a company that had just done a public shell offering. What these guys did is they took a shell with non-operating background, public, did a
like
secondary
a SPAC type of.
Back then, it was just literally they take a public shell with a non-operating background, and they'd merge it into an operating company, and they do a secondary offering to raise capital.
Because it's easier to take it public that direction.
It was effectively already public.
Yeah.
And so a lot of them failed at the secondaries. This group actually achieved their secondary, but then they bought a bunch of assets that disappeared, and effectively they were distressed assets. So we acquired that entity, used the public stock to buy 2 other companies, and we woke up with basically about $110 million public telecom companies with 200,000 customers. We sold that business. We went from the NASDAQ small cap to the NASDAQ national markets, and we sold that business to a company here in Austin. And that's how I learned about the data center business, because the company here in Austin, we were their first acquisition, but then they bought a little data center business. And I remember studying that business. And what I loved about that business, it was all capital intensive. There was not a lot of humans. In the telecom business, we had, hundreds and thousands of employees in call centers, both operating call centers, where you've got technical people, and sales call centers. Very, very difficult business. And so what I loved about the data center business is, it was a very clean, simple business model, but we were approaching it exclusively from the network side. We were not approaching it from a real estate
services.
side.
Yeah, completely different.
Completely different. So when I started,
In fact,
Cyrus,
when you were at Cyrus, did you sublease space from digital, the wholesale side?
We did.
Yeah.
We did. In fact, Chris Crosby sold me a first lease, and we started our first deal in Houston, and we launched in Houston. We were growing, and when I needed space in Dallas, I contacted Digital. Crosby was my contact.
Is that the first time you met Chris?
And Jim Smith
Shit.
was the technical guy. We got space at 2323 Bryan for one of our clients. It was our first reach out of Houston.
Sure.
And so, yeah.
How big was that program? Just curious, back in those days.
That space was maybe 5,000 feet. I mean, it was truly just a backup site for one of the energy companies in Houston, and it needed to be, far enough away, but not too far. And so 2323 was the best building in Texas. And
so what year time is this? So when you're taking this IPO in digital, and I mean, look, that was a game changer, right? The industry didn't have a lot of publicly traded companies that were playing on the REIT side. It basically said,
didn't have any until
we're
digital.
Not technology players, we're real estate players.
Well, the big reason was we didn't know how the IRS was going to treat the rents from the data centers. So digital was able to eventually get a favorable letter ruling from the IRS. And then Equinix got one on cross connects, which was a game changer too.
Is that what made you guys go out and buy Telex?
A lot of reasons to buy Telex. Telex was well, let me back up.
Okay.
So what's interesting is when digital.
And by the way, guys, there's this is just us talking. The genesis behind this was, I have some stuff I wrote down that I thought would be great to hear you guys unpackage, because I believe that one day there'll be kids writing college essays and papers about this industry, and they're going to be referencing this podcast and others that I've done like this that have the guys that helped start this industry on it. So I don't really have an agenda other than to unpackage what you guys think is the most important, because someone's going to write a paper about things that are going to fall to your face today.
So, so I'll back up though. I mean, Dave's right. I mean, digital was a real estate company. GI was a real estate investment platform. Rick was a real estate investment banker. So that is definitely the genesis of the business. We did not do development out of the box. We were buying basically stabilized cash flows out of the box, data centers that had recurring income. In fact, when we went public, we had 6 or 8 office buildings that were leased to technology companies, and we bought them at incredible cap rates. I mean, granted, these things were being purchased, after the .com implosion, and so they were double-digit cap rates. So the IPO was a highly accretive deal for GI Partners. But so we started out buying these stabilized deals, in essence, recurring cash flows. And then in 2005, we bought 350 Survey. And that was a little bit of a game changer for us in terms of our business plan, because one, it was the gateway in Chicago.
The number one carrier hotel.
Yeah. We bought it at a 9 cap. I still remember these details. It was $147 million. The cash flow or NOI on the asset, I think, was $11 million. It was 30% vacant. So what do you do with the vacancy? Well, we build it up. It's a value add play. So when I left digital in 22, the NOI on that property had grown from 11 million to over 70 million on the 30% that was built out.
Property.
Yeah. Now, obviously, you have to add capital to generate that NOI. But that was the first time that digital had actually taken what I would call development risk. It wasn't ground up development because you were building inside the envelope of a building. And it was, I wouldn't say it's a no-brainer, but there were a
There's a
lot
little
of
risk.
Yeah, I mean, you had existing tenants that were looking to expand. Interestingly enough, let's talk about Cyrus being a tenant. One of our top 5 tenants for the longest period of time was Equinix.
Interesting.
We weren't competitors. They were a good customer. I used to take Steve Smith and Keith Taylor out all the time to entertain and play golf, and because they were an important customer.
And they just wanted to control your carrier hotel or the rooms. They
were renting out of our gateways.
Yeah.
We called them internet gateways. That all changed when we bought Telex, though. Because once we bought Telex, they realized we were a competitor because we were buying the number 2 interconnection firm in the U.S. Telex was a major tenant of ours in these gateways. So there were a lot of synergies for us to sort of internalize that. And that's how we got into the co-location business.
As you going backwards from wholesale into they had 1 or 2 clients under a roof. You were having 200 to 300 clients under a roof.
Absolutely. We were a sales-driven model. In fact, when I built the team, first thing was, how do you find people to build relationships? And at the time, we were just in Houston. So, nobody had heard of this, right? The large energy companies had never taken a server off their campus. We weren't focused on interconnection and network. We were focused on getting the back office to a safe place. Remember, hurricanes were big in Houston.
DR was the product primarily for retail colo, right?
It was never DR.
It was.
The reason we went big in Houston was because we realized that the network wasn't big enough to get things out of town as far as production assets, but the layer 2 network was big enough to get things across town. And so what we basically said to people is, you can think of us as DR, but you're going to pay the same amount of rent as you would to run production. Why wouldn't you run production out of a resilient, a building designed to take care of your international employees, customers, everything, instead of being in the downtown building or on your big campus like some of these energy companies had? So they basically said, if I'm going to write the check, I might as well put production down the street. And so we became a production. We had DR for just the trading firms. But at the end of the day, we were selling, it's hand-to-hand compat. It was one deal at a time. We did not buy any stabilized assets. I mean, we came from the exact opposite way of digital, and we needed salespeople. We needed to build relationships and get people comfortable doing something they had never done before and move production far, far away. And they just really had a hard time. In fact, my favorite conversation, and I knew it was coming, is when we had a deal done and they had to do it, whether it was because of Sarbanes-Oxley or because of some other regulatory issue or who knows what, they're out of capacity. I'd get a phone call, and the phone call was always the same. Hey, can we meet? It was the senior executive, and usually in the technology group, CIO, CTO. It'd be a one-on-one conversation. It was always this. Hey, before we do this, we're doing this. I'm not here to negotiate. We're doing this. But before I do it, I have one question. I have to look you in the eye. And I said, what's the question? Will it work? Will this physically work? Can we move these things away from?
Because the product back then was reliability. You're selling a modified gross. Or no, he's selling modified gross all in to the rack level, or even maybe half.
No,
rack.
Full racks.
Full rack only?
No, separate.
And your wholesale that was selling any product they want, as long as it was this size, like 1.25. What was the digital had a product? It was, but I mean, you guys, back then it was Cyrus versus digital versus whoever's design on a block redundancy versus reliability at that time.
But I would say
the product, right?
I would say we weren't competitors, just like we weren't competitors with Equinix. It means that digital's game initially was to get the lowest cost of capital we could, and then invest or allocate capital on an accretive basis. And that's how we grew. It was a real estate mentality.
And that was was that like, I'm going to go buy 365 Main, or you were just buying other
yeah, we were looking at the cap rates versus our cost of capital, and if it was accretive day one, and we had the opportunity to grow it, that's fine. But we never really underwrote growth. We were just underwriting in-place cash flows. We'd always get the growth, but we never underwrote. We never counted on it.
When we leased space from digital, we leased by the UPS. So it was never the square footage. It was, here's your UPS. It's dedicated. Power. Right. There was no oversubscription. I didn't have to worry that this guy's going to take my power. We were at Greenspoint. We were at Midway in Carrollton. We were also in 2323. So before we even got to Dallas, like in a bigger way, in Louisville, we were already a tenant of Digitals in 3 different spots.
Were you guys engaging? Were you still with Jim and Chris?
Yep. I was working with Chris.
You were the CFO at the time then, probably?
I was CFO, CIO, Chief Investment Officer.
Got you. Okay. So
I met Chris in 04 at a conference, and we became fast friends. And
Sure.
as soon as I knew we needed the capacity, I just picked the phone and called Chris, and I just trusted he was going to direct us to where the best solution was for our
Because
for
they
our-
were
our
selling
use
it to you
case.
triple net, right?
Exactly.
And then you would go do
And
your tenant improvement to it. And,
They'd mark it up, basically.
yeah.
We'd mark it up,
Like
make
retail.
money off a bill,
Yeah.
like I'm doing now.
Yeah. And our focus was on even back then, our wholesale customers were what became the hyperscalers. I mean, I remember early on when Facebook was still private, one of our sales guys wanted to do a deal with Facebook. And I said, well, who are these guys?
Let me guess. If it was Dorico, he probably lost his mind.
No, it was somebody on Crosby's team
Yeah.
because Crosby led Salesforce. And I said, so I got a Facebook account, figure out what they did. And I wanted to get their financials. They were reluctant to give financials. And then I went down to see the CFO at Facebook, a guy named Gideon Yu, I think it was, who had come over from the 49ers, I think, or he'd been the CFO. And we spent a lot of time chatting, and I figured out
Like, is your business even stabilized to underwrite this deal?
so the credit really mattered.
Yeah.
And I thought, okay, these guys look okay.
They're not going to go anywhere anytime soon.
I get it. So
Early stage.
I approved the lease, and we kept doing a lot of business with them. A guy named Tom Furlong was the senior guy down there.
Navy guy.
Yeah.
Yep. Real good guy. Real nice guy.
Yeah.
But my interaction was more at the larger footprint customers.
Yeah, because you guys were doing the large wholesale deals. You guys were doing dedicated buildings.
Yeah, so I'd meet the data center guys at JP Morgan and Morgan Stanley and
That's
as
funny.
well. Yeah.
It was still like tier 4 games back in those too, right? All those money groups were still doing tier 4 designs, right?
Right.
That must have been, I mean, was that as
And
good as
lots
the
of-
all-in days for you? Like that was,
I mean, our all-in days were crazy margins. I mean, we were able to attract mid-cap private equity, which was looking for high 20s, low 30 returns. So, when you're selling an all-in and you're getting people to use, 25%, it's take or pay, your flow-throughs
That works.
are really strong. That's why we didn't want to own the real estate. If we can make low 30s returns on capital, why would I want to own a
because you
a
don't
high
want to
single
deploy
digit
capital
return?
under the MEP.
So we'd give the real estate development guys, all the upsets as they wanted. Why would I take precious capital and make it's a low double digit, single high digit return when I'm going to make a high 20s return, hand over fist? I mean, we had no interest in the real estate.
And we were trying to minimize expenses, maximize margins. We went public with 10 people. We ended up with 20 a few weeks later because a lot of those people were on Chris Crosby's payroll at Proferian.
Sure.
But we still had 20 people within a month or so. And I don't know how many you had, but I'm sure a lot more than 20.
Yeah, we had a sales team,
completely different service
and we
model though, too. If you have a couple hundred people under a roof, that's a lot of service touches. Where if you have one client under a roof, it's easier to maintain.
Yeah, we had
I
a
think what
6-person implementation team.
I think what would be really interesting to hear, though, is how Cyrus as a private company got into, combined with Cincinnati Bell in some sense.
Sure.
And how that became public and how Gary became part of that.
Sure.
Because that's
Sure.
Let's hear the story.
I mean, I think it was probably,
Was that the second? Though you went to Abry first, right?
So, yeah. So our first recap was, we basically started out with, I had the telecom company we sold. Me and another family started the business with, our own capital at the time. Data centers were not just a 4-letter word. You couldn't raise $1 after the .bomb bust.
I read an article once that said that you picked the name Cyrus. It was like you were doing some homework with one of your kids, and it was like King Cyrus or something like that.
I'll tell that story in just a second. I'll finish up but yes, it's Cyrus the Great. But basically we were a business that ran, the good news and bad news on every time you sold the deal. Great news, we sold the deal. Bad news, we need $10 more million, $20 million.
Yeah.
And at the end of the day, it's like we need institutional capital.
Yeah.
So we went out and we were able to recruit, a lot of interest and picked Abry. Abry, fantastic partners. We were their first data center investment. They went on to be the largest data center investor at the time. They had like 7 platforms, including, Canada, Germany, Centrum in the UK, hosted solutions.
Are they still as aggressive as they were?
No, they kind of, all the mid-cap private equities kind of cycled out of the business.
Sure.
But the next phase was you needed really cheaper capital. This becomes a cost of capital game. And Cincinnati Bell was a business that had a division that had acquired a few data centers from GE and from Kroger. And, they did some sale leasebacks on some data centers, and they saw the value of this. Data centers were trading, in double digits. Telecom companies were trading in, four turns or lower, and they saw this incredible arbitrage. Gary saw this arbitrage, and he did a brilliant move. I mean, he acquired Cyrus, but kept it separate. He moved the Cincinnati assets in at book value, and then he wrapped it all around and did the IPO. And so, that was a financial engineering move that unlocked a ton of value for Cincinnati Bell and ultimately paid off a ton of their debt, which they were encumbered by debt. So that's how we ultimately chose to do that deal. And we didn't, it was Gary really engineered that deal with Jack Cassidy, who was the CEO of Cincinnati Bell. He took this big risk on paying, a massive premium for this Texas company from this little regional bell operating company up in Cincinnati. Really a local bell, really a local bell operating company. Jack took the big risk. They paid up for Cyrus, and Gary, engineered it around, and that's how that went. I went to the board when we went public. Wasn't a public company guy, and I look at it as I went to school. I mean, I became a student of both the REIT business and a student of just public markets. And so there were a couple of board members that became incredible mentors to me. Bill Sullivan, who is the CFO of Prologis, became kind of my educational tutor.
He was, or he is today?
He still is today. I still talk to Bill regularly. He's brilliant REIT CFO who lived through 3 different massive cycles. So he saw it all. Todd Nielsen, I'm sorry, who was one of the founders of VMware, then became Salesforce Financial Force CEO. He was another great mentor to me. And I became a student until it was time for me to go back. I think companies go through evolutions where they need different leadership. And we were at a point where we had to deploy tons of capital, and I did not have that skill. Gary did have that skill. He came from a world where they were deploying tons of capital. And I was an entrepreneur. I just did not have that skill. I didn't understand that. But by going to the board, I was the eyes and ears of the data center for the board, and I was a student at the same time. So it was great for me.
As you know, I asked you a lot of those types of questions because I have the same fear. One of the questions I asked you earlier was, I'm like, there's 5 stages of building you create it, then you stabilize it, then you standardize, optimize, and scale. And I'm learning that I may have, I think those first 3 as an entrepreneur are pretty hard. I mean, that's where I think is the bloodbath part, right? I mean, you started, sounds like digital wasn't that old when you guys IPO'd it either, right? So
we had 18 or 20 buildings. In fact, our enterprise value was $700 million at the IPO.
Really?
And we were the second largest IPO in the Bay Area that year, second to Google, actually.
No kidding.
And when I think our peak valuation when I was there was $78 billion. So from $700 million to $78 billion.
That's incredible. And at the time, there's probably only one company that had a bigger market. To this day, no one has more space, power, and cooling volume than digital, correct?
Well, we don't know anymore, right? I mean, among the public companies, it's just Equinix Digital, but QTS could have more space and power.
Oh, because they're privately held, like Cyrus is private now.
That's right.
You had to take it private, right? Were you?
So I did take it private.
Yeah.
I mean, we don't know. There's so many platforms between, QTS, Cyrus, Aligned, Vantage. These companies have grown.
Switch is large.
They've grown.
Yeah, you're
Switch is, grown. They've all ballooned in the last 5 years. So
when you guys were like, listen, so let's zoom backwards. Here, you need some more of there, Bill? You need some more loudmouth soup? Let's get you just a little bit more of this.
All right.
My thing is,
thank you.
There is no chance that, even with your guys' big fat brains and the risks that you guys were willing to take back then, there's no way that you saw the industry and where it's at today.
No chance.
So let's talk, man, because that's the stuff I want to bring. Like, there's people that are paying attention to this podcast that don't know they haven't seen the ball since kickoff, right? There are people, there's people that are in this industry and don't know a lot of things about it. They don't know the difference between a CyrusOne or a digital. Even to this day, they don't know the difference. And to this day, there may be a lot. The gap of differences between those two companies, it's not zero, but it's not as wide either. Right? It used to be way different. When you guys bought Telex, you guys were moving one direction. When Cyrus no longer, I think to become retail colo, 75% of your revenue, technically, this is, maybe you could tell me what these laws and rules were from a finance basis, but to be a retail colo provider, like 75% of your revenue had to be generated from like cross connects and something else that was smaller. I remember Wojo was explaining to me a long time ago.
I think the issue that companies were dealing with initially was how much of that retail service revenue was readable.
That's right.
What does that mean? Readable means you could look at it like an annuity over the course. Because the
REITs are typically rents off of leases on real estate.
Okay, but was there a minimum requirement for how long those leases had to be?
No.
It was obviously more favorable based on the length.
Hotels are REITs, and those are daily leases.
Oh, okay. I didn't look at those optics. Yeah.
Multifamily REITs, those are annual leases.
So they're just hedging that based on average occupations?
We became a REIT with, our average term, if you will, because they weren't even leases. They were master service agreements. We converted to leases ultimately was somewhere around 4 or 5 years. I mean, they were doing 7-year leases. We were doing 3-year service contracts, mostly. So it's not about term. I think in order for the IRS to give you a letter ruling on REIT revenue, it has to meet certain type of threshold. So a cross connect became REITable thanks to Equinix, because it's just recurring revenue that doesn't have an incremental capital. It's pretty much simple.
And the real estate is the plastic conduit that costs $15 that you make maybe $300 on.
So
150, 300.
So in those days, though, there was you were so focused on building a stronger service and delivery team focused on, what was the CyrusOne model evolving to? What was the digital model evolving to? What was your goal? That's what I was saying. You guys didn't have crystal balls that knew where the industry was going, but you were trying to pivot the ship. What were you analyzing and interpreting? What were the tea leaves that you were reading, and how did you get to it? Like, going back, what would you have done different, type of thing?
I don't know what I would have done differently, to be honest with you. That's interesting, because I've thought about that. I was looking to, especially when I became CEO, I was looking to use our cost of capital advantage to make accretive strategic acquisitions.
So is that why?
And I started with Telex, which gave us the co-location interconnection capability. And that was easy because they were managing interconnection inside of our buildings. They didn't have a lot of footprint outside our building, although they had some. And then, we bought DuPont, which gave, I say we, Digital, but when I was there, we bought DuPont, which gave Digital a dominant position in Northern Virginia, the most important data center market. And then it gave us a significant presence with Microsoft. Microsoft was Hussein's largest customer. So
he had incredible numbers, right? He had 12 clients, $600 million top.
He had a great model. He did triple net, which I loved.
Yeah.
I thought he had a great business. He wasn't there when we bought it. He had left at that point.
Yeah.
But I ended up negotiating the deal with Lamont DuPont, actually.
Oh, really?
Was point on the deal.
Really?
Yeah.
Eldridge was out by then, maybe?
Eldridge was still there, but I would say he probably had a little bit of a conflict, because in selling to Digital, it wasn't clear there was going to be a role for Chris afterwards. So Lamont took.
He's a carrier guy though too, wasn't he? He was a network guy. He came.
Yeah. So I didn't have a history with him. I knew I got to know him. Only after he was.
Lamont was point, but then we made. At that point, we started making decisions on a geographic basis. So we got a Senti in Latin America, which gave us the largest footprint in Latin America. We bought Interaction, which gave us,
So was your number one goal just going out and finding cheaper money the whole time? You just never stopped. As your CEOs,
we focused on investment grade debt, and
didn't you guys float your own bonds or something? You guys
we issued unsecured debt. We got investment grade ratings, I think, in 2009 in the midst of the financial crisis.
Cyrus eventually got there too, right? I think Equinix.
It took Cyrus a long time to get there.
That's hard.
The public offerings in 2013, there wasn't investment grade till probably 2019, 2018, 2019. It took 5+ years.
Why did you know that was the direction to take it?
I was a finance guy.
Okay, so you just knew.
Cost of debt was going to be a significant advantage, not only in terms of cost, but availability. The high yield markets always dried up in a downturn first. you could generally get access to investment grade debt at some cost. I mean,
Interesting.
and look at the difference in borrowing rate for Digital and Cyrus for the longest time.
That's why we traded. We traded 3 to 4 turns below these guys. Part of it was that, part of it was scale.
Yeah, it translates into equity multiples too.
Yeah. All right, so let's zoom out from the business side of it. You guys, I'm going to bring it back to where I could kind of try to bring you. It's like a Guy Ritchie story, right? Where I want to weave both stories, because it was, for me on the outside, I think Wojo did a good job. Tesh did an incredible job.
Incredible.
He's a CEO now. He seems like a highly respected, a highly regarded dude in this industry. I know that I was a better professional having sat in rooms where guys like him or Hayden and Jen Smith, or, there's so many captains I think that I was watching in the early stages. This is an oligopoly. This isn't a massively saturated industry. There wasn't a ton of digitals. There wasn't a ton of CyrusOnes is what I'm saying. I could go to the airport. There's 5 to 10 players I'm going to find at every airport in the United States. There's regional players in New York or New England or LA perhaps, but in the most case, there wasn't a big industry yet, right? So you guys are trying to create and build an industry that you both are trying to lead from different altitudes and airspeeds. And you're trying to be number one in a market that doesn't really even truly exist yet. I mean, our industry, think about it, from 100 years ago from now, 1925, that was the automotive industry, right? So for people that are listening, we were building Model Ts until 1927. So we weren't really, the automotive industry, when it pushed out, there was not a plan for making sure there was enough service stations and gas stations everywhere. There wasn't a trained workforce that could go work on cars. They took them to bike shops to get fixed because you couldn't even get spare parts, right? So this industry, when you guys were starting in 2004, when did you start CyrusOne?
2000. We launched in 2001.
Okay, so think about it. This industry didn't exist yet. So
No.
I don't know what you were explaining to people that you were doing for a living, let alone what you were telling the banks. It probably was easier as a REIT side, because that side is an asset class that's pretty understandable. But on the technology services side, people are like, I don't get it. Right.
We had a hard time early on just convincing people that they had to adopt a new way of doing things. And so,
Even outsourcing?
even out meaning take
Being
your
on-prem.
back office, take your mission critical, production environment, could have been network based, could have been non-network based, internal facing, and put it on the network, if you will, right? Network based computing. It's almost like we went from the mainframe to the client server, to the client server to back out to the network. So we're back to network based computing. At the time, we were literally out just evangelizing that concept on a hand-to-hand combat
So your
basis.
competition wasn't him. It was the client themselves that wanted to build their own shit on-prem?
It was always the client. Like
Yeah.
it was either build it or buy it.
Is that what your competition was too? It wasn't him, it was the customer themselves that wanted to keep it on-prem? Or because of the scale that you were at, was it the economics would have never penciled out for them?
That wouldn't have worked out. I guess that you could have had a very large building. I mean, our business changed materially, and yours might have too after 9/11. Because
Interesting.
9/11 demonstrated the need to get the servers out of the office buildings with the workers and put them somewhere in a more remote, secure location away from critical employees.
So was that like the housing correction, the collapse of the secondary lending market in 2008? Was that a negative impact on the market? And did you see a drop then?
We saw. So there was another thing that happened around 2008 with that happened at the same time as the housing market
Yeah.
crash, and it's the advent of fracking. And so what happened in Houston, Texas, was you had
That's
all
a
of
boom.
these massive energy companies that had no access to capital. So the capital had to be used for revenue generating strategic purposes, drilling holes in the ground. When the IT guy came and said, I'm growing at this crazy pace and I need more technology, they'd say, you don't get any capital. It's going to plug holes in the
Because
ground.
it's not generating revenue.
And so all of a
Yeah.
sudden they're like, what else do we do? And company like, well, we were the only one in town, quite frankly, became relevant. And so we grew at a massive pace during the housing crash, primarily because our customers needed access to infrastructure. They didn't have the capital or time to do it on their own. They had to deploy infrastructure really quickly. Their internal, facilities teams, if you will, in construction could not have built it fast enough. So we became a default. They didn't want to use us. They were kind of forced. It was the only option.
So fear on one side and economic efficiency on the other. They just didn't have access to the capital, so they can't build their own. They just lease the optionality.
Right. And back in the days of Cyrus, if there weren't those relationships built by all those salespeople, there wouldn't have been the comfort. It would have been too foreign. It would have been too risky. And so they would have, I don't know what they would have done. But back to the conversation around what would you have done differently? We built culture and we built energy and we built salespeople. And ultimately, back to Tesh. I mean, when Tesh came into the business and Gary recruited him in, Tesh and I had been friends for years. He carried that forward. He brought this energy and this clarity and these customer relationships.
Yeah.
And this intensity. And, I've always said it, like he did carry that forth. And what they did to build and take this couple regional companies and create this, quite frankly, at the time, a national footprint, I attribute to what Tesh did to build that
his background was
footprint.
a little Telex, a little QTS and stuff like that.
That's right.
He was at Telex when we bought it.
Yeah.
But I just thinking about what you would do differently, I just realized there were deals we should have done we didn't do.
Like one? Like which ones?
Well, we should have bought the other half of the Weston Building Center. We were in negotiations with the owner of the 50% we didn't own, and the deal didn't happen because of a stupid term and a lease estoppel. Should have just eat the term and done the deal because we ended up buying it for a lot more than what we could have bought it for. We should have bought 151 Front Street, the Carrier Hotel in Toronto.
Why didn't you?
The view was that the price was too high. But the price, you always grow into these things.
Yeah.
The growth rate's incredible. So there's the deals we didn't do.
Okay, interesting. Did you have any of those deals you wish you could?
Cyrus always had a challenge doing inorganic growth and using our balance sheet, even as a public company, because at the end of the day, we were smaller. And so while we were the third largest public company, and there were two, QTS was smaller than us and Switch was smaller than us. So
of course, I was floating around.
Of course, I was, a little small. The assets we would want to buy, ultimately he bought. And so Bill was able to use the balance sheet and in a creative way where it would have been too dilutive for us. And so we would have been punitive, it would have been too punitive. So, we were ultimately going to create all of our value by being a developer. And that's where Hayden comes in, right?
Sure.
And so
his product was speed to market and volume.
Speed to market, intensity. That same culture just kept through it. Gary kept it going. Tesh kept it going. Hayden kept it going. Timmons, the whole crew just kept it going on steroids. And that level of speed to market is the only differentiator we had because we couldn't use the balance sheet.
See, the interesting thing about the REIT model, it works both ways. So if you can use your capital to make an accretive acquisition, it only grows the bottom line, but it helps your multiple. So it makes you can buy even more. It keeps going up, up, up. But it works in reverse. If you use your capital and you make a dilutive deal, unless you can hopefully demonstrate accretion very soon, the REIT guys are going to penalize you and knock your multiple down, and then it makes it harder to do accretive acquisitions.
Was the whole goal? It seems like Cyrus's goal at the time was to continue to punch outside of its weight class, going after were you feeling them at the time? Like, at what point were they on your radar? There was a time where they probably didn't count. I'm not trivializing what you were at, because I remember when you guys were just a 13,000 square foot data hall in Houston as well. Because I was a UPS service engineer back in those days, and like Dennis Scheib, Kenneth Wolverton were the guys. They'd come out, and as I was putting rotary UPSs online for you guys, someone would come out and be like, I heard you're a submariner. So they'd want to ask me questions and talks about sea stories and shit. You may have actually come out once when I was, and I remember one time, I think it was you, because I remember you're a pretty unassuming guy. Like, you don't walk in like, I'm the CEO of, whatever. And I remember I'm like, who is that dude? And they're like, yeah, that's our CEO. And I was like, he seems really cool. I expected him to be, a lot of pressure at the roles that you guys had in those companies, right? But like, when did CyrusOne get on your radar? When did you start taking them serious?
To be honest with you, I'm not sure we ever did. And I don't mean that. I don't mean it with any offense, but if you think about what we were doing, if we were doing small footprint, We were doing small footprint in our strategically important internet gateways where people just needed to be there. And Cyrus didn't have that, didn't have internet gateways in their
No.
portfolio. And
So
then,
guys, Josh, I guess, is probably what helped them open up their network solution. Snowhorn, is that what they?
That's right.
'Cause they-
Yeah. So I mean, at the end of the day, our network services were cross connects. They were never network based cross connects. They were, how do you get your business to somebody's network?
Yeah.
We were never an interconnection
Well,
business,
because
even after-
digital was always like Tash or whoever it was that created a campaign. It was a David versus Goliath campaign where it's like hockey. You know, you ever seen that movie, The Miracle? But and the Herb, the coach was to get the team to kind of coalesce around one. They all had to hate one person collectively. One thing they had in common. And I'm not saying everyone hated digital, but it did seem good at CyrusOne. We celebrated. I think the bell rang when you won a deal, and you rang the bell twice if you got one from digital. And it's funny to hear you say, you're like, we were never paying attention to them. That's Cyrus was, and it helped them. It helped because
that's
competition was healthy, right?
Good for them. But I mean, if you also think about it, the deals we were going after on the wholesale side were probably too large for Cyrus, at least for the longest time.
From a capital perspective.
They were big footprint deals.
They were. So I think we were always chasing digital because what we woke up and realized is that the 3 and 4 cabinet deal is not going to get you there.
Sure.
To move the needle, you got to sell bigger deals. And so we started moving towards much bigger deals. And this is where, Tash built a team of people that knew how to do that. And Hayden would go, and build these sites out in 6 and 8 weeks to make sure that we can accommodate it. But we were chasing them because, quite frankly, they didn't have to convert. We had to convert to a REIT. We started out where we started. We grew into a real estate company, right? These guys started as a real estate company and just became a bigger real estate company.
Was it a REIT before it IPO'd?
No.
I didn't think so, right?
No,
so
it was conversion. And, give Gary all that credit. I mean, he realized cost of capital was, and REITs were going to have a better cost of capital. And at the end of the day, while we had to, quite frankly, go private because being public was actually hurting us.
Okay, cool.
We should have, I certainly believed we should have been private even earlier than we were because we couldn't use the public balance sheet. We were capped on leverage being a public REIT. We were really trapped. I mean, we had a limited growth. It got to the point where we had to
say no to deals.
We had to say no to deals. We got put in the penalty box by a hyperscaler because, it came down to one building, two people wanted it. And, you had to give it to one. We got put in a penalty box for 2 years, couldn't get a deal from one of the big hyperscalers for 2 years because the team had to make that decision. I was on the board at that time, but it was a big conversation because ultimately we just were trapped. We didn't have the capital structure to stay public. And ultimately when I came back in,
it just doesn't give you enough levers to pull on, I guess, because you're so confined or restricted.
You're trapped. They were big enough to where it didn't hurt them.
Well, not only were you big enough, you could float your own bonds and raise capital that way. You didn't have to dilute anything, right?
Yeah. And keep in mind, during a good bit of that period, interest rates were really low. So I think it made sense to go private because you could leverage the heck out of your balance sheet. It could have a very high debt to EBITDA ratio, but its coverage ratios would be fine because interest was so low. Interest rates were so low.
And you guys could do that.
Well, you could do that once you went private.
We did once we were private. Look, what the big strategic hurdles that we got through when I was on the board is Gary brought Jonathan Schildkraut in, and Schildkraut came from from Wall Street. He really understood the space. He was early on at Jefferies back in 2003, 4, 5. We'd talk about the data center business when he was writing research on digital and Equinix. He helped those guys figure out kind of what's the path to Europe, which was the biggest move we made. He was able to, being a Wall Street guy, help those guys really figure out what the best path to strategic growth was.
Yeah.
But we also had a company to just kind of like the playbook was there. We just had to go do it.
Yeah, I think that Forrester, right, there was probably a moment in time where no one was building more data centers than digital. Jay was your probably quarterback at the time, right? And I remember when we were at Cyrus, I remember asking like Hayden and LD what their plan was. They're like, we kind of just got to pick up where digital left off on their versatility or flexibility on delivery of some kind, right? Because there was a time where it was a very specific product that was being sold, and that product was measured on a function of reliability. and it didn't matter because everyone was signing a 2N SLA.
2N.
Yeah. So regardless of what right. Does that make sense? At some point, the product stopped being about reliability and it started being about speed to market, right? And volume as well, which is probably.
And once the cloud came out and the cloud providers had their availability zones, 2N was less important because they could fail over to a different
replication within a market
data center. Yeah.
That they changed the game because they lost confidence in the operator, so they just built that reliability at the network level.
They also ran it hotter, which is interesting too. Some of these guys started to run really warm data.
Like hotter than AshRay would say they should, or were they just pushing the gear to a specific limit that said, AshRay says this, but the gear says that. So
you'd walk in the early days, you walk into a data center and you need to put on a parka against it'd be so cold.
Those days.
Later on, it could be high 70s, low 80s, they were okay losing chips and processors and just servers, replacing them, throw them away. Better to reduce your power costs and throw in a couple of servers if they fail.
So what were some in your minds? I don't say the industry has ever hit a plateau. The S curve is always, slowed down, I guess. But you have the World Wide Web or the Internet of Things, or September 11th, or the collapse of the housing market or the secondary lending market.
By the way, financial crisis was good for us, though.
From an industry perspective?
Well, it allowed us to make a bunch of acquisitions on a very creative basis because we had capital. We had a great balance sheet. We were delevered. We had committed credit facilities, and we were able to buy stuff on a very creative basis during the financial crisis.
So I used to sit in on when the earnings reports would be read. I always listen in just as a student to try to understand what was going on. And there was no loss of momentum in that time. Cyrus was rolling and digital was rolling. I mean, the industry as a whole
didn't slow down at all.
But it's funny, as we were rolling, we never bumped into these guys. Maybe in Dallas, we might have bumped into you guys when we were trying to, do some deals. But in Austin, we didn't really bump into these guys. They were full. In Houston,
you ran into each other in Phoenix. You definitely had to bump into each other.
We snuggled up next door to these guys after they bought 365 Main.
They bought 121 East Van Buren too, right? And
we bought the Gateway in Phoenix, and then we bought 365 Main, which had the Chandler.
Yeah, Chandler. Yep. Yeah. And then Cyrus went out to Chandler too and built that
next door
consortium. Yeah, that was a big monster campus, right? So, all right, so you guys did. So that's
when we started. I'd say that's when we started probably bumping into each other.
Yeah, because Cyrus was chasing those wholesale deals, and they had to. I'm not saying if they were taking any away from you guys, but you guys weren't chasing the deals that these guys were on, really.
When did you buy the parcel in Chandler? What year?
2012.
Okay, so pretty soon after we bought 365.
Yeah, maybe. Yeah, exactly. So when we stood up the first site, that's when quite frankly, Gary had taken over as pre-IPO, but I was on the board, and Timmons and Hayden
you guys
built
were doing
out
indirect
that site
for the cooling at that one,
and and they made that happen. That was a great move, and that's once again back to I had to learn how to deploy capital. Gary and his background being an institutional public steward of capital, he understood how to deploy capital in big chunks. And to me, it was always, as an entrepreneur, it was always I had to learn that. So Chandler was the first big expansion outside of, say, the two regional hubs.
So zoom out. What was the industry like in 2012? What were some concerns that you guys may have been facing other than access to capital? Yours wasn't capital. What was your concern then? Losing to people that were coming in the market for the first time and had access to shit tons of capital? Because there was a lot of people coming in saying,
I'm trying to think back on 2012. We had our CEO change in early.
Is that when Faust left?
Yeah,
you took over, right?
Right, and so there must have been, at least at Digital, there were obviously issues in the company in 2013, which resulted in Mike leaving in early 2014. But I actually, the share price was down. It was in the 40s. I'm not sure what the specifics were that at this point. It's just been too long.
From the optics of the outside looking in, it looked like Digital was in a defensive position that was only trying to go buy. Well, it sounds like you took it back to where it started, where you were just trying to buy FFO and NOI. right? And you weren't going out and building green fields like Cyrus was going into new markets like San Antonio, and they were building massive greenfields.
And I mean, that could be, as I said, I blocked that period out of my mind. I mean, I hate to say it.
Yeah.
We had our largest investor at that time, and for some time before that, was Capital Group out of LA. The portfolio manager was Rich Wolf. And so Rich was, had gotten pretty active in digging into the company because he had a 10% position basically.
Yeah. So he was very involved on the board level, it sounds like.
He actually did meet with the board once.
Okay.
That was in December of,
he had a strong opinion on a few things.
Yeah, he had a strong opinion on some things. He was a good man though. Rich and I, as you would expect as a CFO, Rich and I spent a lot of time together and we became pretty close.
Nice. What was the outlook at that time? You guys were seeing any, like today, people talk about the AI slowdown, and what the market looks like when that happens, right? From a greenfield perspective. Was there a big concern about the cloud growth at that time where you're like, it's going to hit a plateau, cloud will slow down?
I don't think so. I guess if I were to think back to 13, I guess maybe there was developing lack of confidence in the stock price was down, the multiple was down. So there was a developing lack of confidence.
Why was that though? Was there someone from was there an RBC guy that came out and said something negative or disparaging about the industry or the asset class? Or?
I don't remember that specifically. I do remember that the hyperscalers were really self-performing. I mean, Amazon was the big cloud at the time. Azure was on its way, far, far behind them. And they were primarily self-performing. So until they needed some overflow, right, they really wanted to build and operate their own data centers. And so, back in those days, it was how do you get ahead of them and have something attractive to them? At least from our perspective, we were getting their scraps. Like, oh, we're growing so fast, we can't deliver. Oh, we need, San Antonio, or we need, Chandler, whatever it might be.
I remember Darren Descarolis. They were building that huge monster in like Dallas or Fort Worth, but he also signed a huge lease with Digital. Right after that announcement of that big one, I said, why would you sign the lease for Digital for many megs as well as what you're building on your own? And he's like, we can only project so far out. And when there's demands that exceed that, we have to outsource. So, he's like, we just can't build it all ourselves. He literally one time was like, it'd only be 5 hyperscalers that would consume 80% of the construction and delivery labor market, which is the case now, but they're doing it distributed through operators as well. Do you agree?
Yeah, I think that's right.
Yeah. It's still happening.
Oh,
I would still the developers were hamburger helper for the hyperscalers.
That's it. They were picking up all the, like you said, the scraps.
But their scraps were the biggest deals we ever saw. And we were their scraps, and probably still are to this day.
Still is, I would say.
Did you ever have a part in which you started having concerns about the slowdown of growth? Because it's cyclical. It's not always.
It's definitely cyclical.
It is, but it was more cyclical when you thought about it as a public company on a quarterly basis. Your mind gets wrapped around quarters, so it feels cyclical.
You report your bookings every
That's
quarter.
right. But if you really look at it annually, you look at just kind of the growth. It was never cyclical. It just continued to grow. It was, as a public company, it might have been you've got a good quarter here and a, absorption quarter here and a good quarter here. But it was never, if you step back from being a quarterly reporting public company, it wasn't cyclical. It was just a rocket ship.
Dave's right, but the analysts and the analysts in particular didn't see it that way. So they focused on the quarter, and we tried to get them to do the last 4 quarters annualized.
Which is right. And they didn't like that.
Yeah, they liked point estimates. They like to take the last quarter and interpolate from that. Oh, world's going to hell. We better pull out of the.
How much just happened a year ago? Like one of the hyperscalers announced they're going to take a pause and absorb, and the whole market went down. You can just go look at the last 12 months and see what. Just look at Digital Equinix.
It was Microsoft.
It was Microsoft. A quarterly absorption, and it was a sell off. Yeah. So that public quarterly mentality exists today, even though what we're seeing today, as far as demand of capital, demand of chips, demand of everything, land, power, labor, it's never been greater. It never will be greater. Yet there was a sell off 9 months ago,
and they don't slow down at the same time, right? They're not on the same cycle.
Right.
I mean, Microsoft might, throttle back a little bit. Oracle's going full guns ahead. Google's going full guns ahead. So it's all different. Timing's different.
But what were you guys seeing from a?
This is as PDI that we were seeing this, by the way, not in our prior roles.
Oh, I got you. Well, we haven't even got to that part yet, to what you guys are doing yet still, because I think it's important that people that are listening, I'm sitting down with the two founders of the two of the biggest data center owner operators on earth, and they're talking about the genesis of this, right? So I say it because 100 years ago, the automobile industry was evolving just like this industry is into the mainstream. And I kind of look at this as I'm sitting down with two of the Henry Fords of our industry, hoping that, my kids and other people's kids will
I'm more the Dodge brothers.
Those guys are crazy. No, I mean, like, there wasn't a lot. There was the Buick team, the Dodge team, the Ford team, and, and it's interesting how they were all so different. But the reality is, they didn't understand what the industry. I mean, Henry Ford's like, my clients wanted bigger horses. We gave them this instead, right? So as you guys are doing this, at what point, though, did you see the industry evolving? I mean, you guys are both doing something completely different now, right? You guys are not on the operator side as much, and you're on the capital side.
We're definitely not on the operator side.
No. I mean, look, I will say this, that when I step back to the board and Gary, Hayden, Tash, and company really took this company, both inorganically and organically, like really big bets. They were experiencing growth and contracts that, I remember when they made their first pitch to the board, they said, we're going to build these 36 megawatt cloud centers. And I remember thinking to myself in the boardroom, nobody's going to buy 36 megawatts.
Is that for real?
It's insane.
Even you said that?
I didn't say it. I thought it. I remember thinking it. I thought, and they had everything clocked out great, and they just sold like hotcakes. And, so I think when people say, what did you see? Forget today, let's go 10 years ago. I'll tell you that the evolution of, and I go back to Moore's Law, right? It started out where we were doing 15 U's in servers in a cabinet down to single U, they call them pizza boxes.
Yeah.
They got to blade servers. Cabinets went from 2 kilowatts a rack up to, at 8 kilowatts a rack. We started worrying about heat extraction, and then they get up to 30 kilowatts in these cloud centers. As we went and quite frankly, everything got more and more dense. We all went to school. Right. We all went to school, even the guys like, in your business who were, trying to figure out how do you
the best
manage
means
these.
and methods were changing every month.
It was, and so no one saw it. If anyone saw it, I'd say it had to be only somebody on the chip side who really understood, how this was happening.
Yeah.
When they said we're going to make a server more efficient, they just said we're going to kick more heat out into your data center.
They didn't say what level.
They weren't making the data center more efficient. They were making the data center less efficient. They were just blowing more hot air out to contaminate the cold air. So, over time, I think this was happening in real time. And from a facility or from a, data center perspective, at least I can say from Cyrus' perspective, it was not super predictable. And I would go as far as saying what's happening today is very similar to the step function we saw from, interconnection and, back office stuff to cloud. We're seeing the same step function today as we move into these 140 to 300 kilowatts in a rack AI deployments.
So listen, we're all over the place here because we started the genesis between a guy from Pennsylvania, a guy from St. Louis, and you guys end up through legally going the REIT route, got into the wholesale side. You going through technology and services, got into the resale side, and eventually, I mean, Cyrus became a wholesale player. They're obviously a big player, and I don't understand. Maybe you could explain to us that are listening, like, why didn't you guys go private? If QTS went private and Cyrus went private, it gave them the advantages where they don't have to worry about a quarterly basis. What was it? Your shareholders wouldn't let you go private, or
we were too big?
Too big at that point.
We were just too large.
There wasn't anybody that could come in with one check. Because then
I suppose Blackstone could have done it, but at that point, Blackstone was just getting into the data center space with QTS. So I think,
did they express any interest, or were there people like that? No.
No, I mean, QTS was, I think, I don't know what was going on inside Blackstone. Well, actually, I mean, we talked to Blackstone about joint ventures and that sort of thing, but I think QTS was a beta for them. It was a test case. It was their way to dip their toe into the water. I mean, Blackstone's so large and QTS was so small. It was kind of like, okay,
it was half our size.
Let's see how this goes.
And they've been around longer than you guys too. So,
it was similar, but once again, they were a pure real estate company from day one.
Yeah, which fit perfectly for Blackstone. Blackstone wouldn't have would have been more comfortable with real estate than services. But I mean, to Blackstone's credit, they've grown the heck out of QTS. I mean, that's
Threw a
become
lot of money at it, for
that's
sure.
become a phenomenal platform. But I would say, and so digital is just too large. I mean, if you look at the real estate companies that have gone from public to private, I mean, EOP was a big deal. Hilton was probably a big deal, but I think those are quite a bit smaller than what a digital.
But I mean, like Dell
go
went private. I mean,
Well, that's just different. It's not a real estate company.
okay.
And they also combined at the time with, storage company, VMware. I mean, they
VMware.
did a huge, there was very different than just a pure play real estate company. And Cyrus became a pure play real estate company after the IPO, converted everything to leases. Before the IPO, we were selling co-location. It wasn't like we were doing, application and managed services.
As
It
a
was
REIT,
just-
though, is it as accretive for you to build greenfields than it is
No.
to go? Okay.
The problem with being a REIT
Yeah.
is that the REIT investors penalize development
Yeah.
because during the development J curve, that's dilutive.
And they're waiting too long to get a return back.
Right. So if you look at the REITs, and there aren't any of them, there are two of them now, but you want to look at, you think about a land that's being developed and construction work in process, those are non-earning assets until they actually start generating cash flow. And that could be anywhere from 2 years to 4
18
years.
months, yeah.
We learned it. I mean, Cyrus was a public REIT that was a developer, and we had to keep this metric called assets at risk. And asset at risk was a metric that basically was a non-cash flowing entity. It could have been land bank or it could have been anything in construction in progress. It still had to be
Land
lumped in. If
bank
it was
counts
more
too,
than
yeah.
more than 15%, we'd get penalized by that. It's a number we had to report, and the team had to report to the board. And so, we learned the hard way. The team would come out and announce an amazing Microsoft lease, but say it's a 3-year build, and the stock accretive deal,
Why
the
is
stock
that?
would go down because they didn't like development risk. They're not earning for 3 years.
Is it because they just don't understand it? Is it a way that you get educated away from that? Is it something that is it more reality than it is optics?
I mean, it's reality because you're not earning on that
But you-
investment for however long it takes to build it and for Microsoft or whomever to start paying rent.
But at the end of the day, once they do, doesn't it bring the incremental value up
It does,
significantly?
but the institutional investor and the portfolio manager is being compensated on their returns today, not their returns 3 years from now or 2 years from now.
And as you know,
So will that end up harming digital in the long term? Not being
Digital's
too
big. I mean, digital's big, so they can do a lot more of this than Cyrus could. Just because it's probably was it 5 times bigger when you guys went private? It was a lot bigger.
So when I jumped back in, it was $7 billion market cap. We were about $60 a share. When we went private, it was a $15 billion takeout.
Yeah.
You guys were 4 or 5 times our size.
Yeah.
When we went out,
Yeah, so
they
we
were
could
still 4 or 5
so we
times
could
our
have 5
size.
times as much development on our balance sheet as they could.
But you couldn't because you were penalized more
Because
for
we're
developments.
bigger.
Yeah. So you weren't able to be as agile from the development side because of the REIT status, right?
Well, we could within the constraints. So if you assume 15%, and the rating agencies have some input there as to how much they want in the development bucket. But I think we managed to about 10%. But at 10%, that still gives you
A lot of money at your scale, for sure, for development. That's massive.
I've never seen them get penalized on doing some development.
no.
We were always penalized because we were never doing, we did maybe a couple M&A deals that were, other than Zenium when Gary did that. And there was another couple deals we did that were smaller.
Well, let's fast forward a bit to, I did write down some questions, but I wanted to see what didn't I ask you about the genesis of the early days of this industry, like that you guys wish that you guys shared with someone, or like you seem very smart. You guys have been successful. You're sitting on that side, and what you guys are doing right now allows you to you guys have a very unique position in the market now with what you're doing. And we're going to unpackage that part next. But at some point, what were some of the scars that you've learned, things that you've seen, or how can you use some of those things to analyze, interpret trends again today? Because everything is not only cyclical at some point, but patterns in history repeat itself in some cases. Do you agree?
I do. I would say, though, what I'm probably most proud of at Digital, we built a great platform, but it's the team. I mean, we hired and developed an incredible team, And as you said, there's so many of these guys today that are leaders of companies today. I mean, you have, okay, Chris Crosby at Compass. You have Andrew Shapp at Align. You have Tony Wasabi, who's, I forget the name of his company. You have,
Microsoft.
yeah, I mean, so much of the design and construction team and a lot of asset management ended up at Microsoft under Noel Walsh.
Well, and Meta, there's all kinds of guys. I mean,
They
digital
went over to Meta for sure. So
digital produced a lot of people that
we
had
had
a huge
great team.
impact on this industry.
We developed a lot of talent. They went off and they did great things. So
Cyrus has done that as well. I mean, Cyrus is.
I mean, look, I'm equally like we grew up as a a team of concrete chewing people.
But you guys
dogs,
didn't know
and-
each other. That's what I'm saying. I'm like,
Yeah.
if people look at the industry, it's a big industry. Not a lot of people.
we got to know each other when I moved to Austin.
Is that
Yeah,
for
in
real?
2019, we got to know each other. And when I went back in 2020, 2021, the first call I got when maybe a public announcement was from Bill. And it was a Wednesday. I had to give our first earnings call on a Thursday. And I was freaking out. I'd never done an earnings call. And in first call, 3:00 Central, 4:00 Eastern, market closes, news hits, so-and-so stepping in, me. Next morning's earnings call. First call I got. So we had to be super,
and good luck.
congratulations, good luck. And I said, I need
Sucker.
some help. And he's like, you'll be fine. So end of the day, we got to know each other much later. And we didn't know each other. Wasn't a ton of overlap.
Did you?
The
did you have
businesses
any
were
desire-
very
It
different.
seems like you guys were so focused on your own shit. It's not that you didn't have reference for each other. You just didn't give a shit. You were just building your own things.
We were just, I
He
mean,
was a
we
director. I mean,
Yeah.
he wasn't.
Yeah, exactly. I was on the board at that time. When he went back in, or when he went in to be the CEO, I was on the board. So I never left the industry. I was always around for the board. It was a commitment I made to the board. But at the end of the day, we got to know each other really well.
And
When he moved digital to Austin in 2019.
what was it like? Because Four Embarcadero is a pretty badass office. Like that view from
It
there
was
is
incredible.
ridiculous.
From the 32nd floor, it was a beautiful view.
Incredible.
From ground level,
Yeah, that part's
not so good.
yeah. Yeah. That was a huge thing. It was a huge thing for people that got it. A lot of people didn't understand the significance when digital shifted their headquarters to Southwest Parkway, essentially, right?
Yeah.
So
Well, to Austin.
yeah, Austin. That's a big deal. So when you left digital, what do you guys do? I mean, after doing everything, taking a $15 billion taken private and all the things that you guys have done, and you've been in that role for almost 20 years, like 18 years, it sounds like, right? And my thing is what's the next thing? Do you guys just take a step back and walk away from the game for a little bit? Or what did you do to get to where you're at now?
We're not walking away.
Well, I know, we're gonna
the
get to-
opposite. I mean, I think what we all started to see, and before I left Cyrus, we signed, the biggest deal Cyrus ever signed because of an AI deal, one of the hyperscalers. We saw the need for capital. And I think they're quoting right now over $2 trillion worldwide
The industry
over the
needs
next
$2 trillion.
over the next 5 years. Like that's starting today.
So is every CEO's only focus right now is raising capital for that?
We realized that there had to be some new, right? So if you fast forward, we did a take private with large infrastructure funds, KKR, GIP, fantastic partners, great investors, extremely knowledgeable, capital markets, everything. But if you look at all the large infrastructure funds out there, they're all in the game almost. There's a few that, never really got in and they're trying to now. But when you're going to need another $1 trillion, where's that going to come from? And how do you get that capital comfortable? And what we realize is that there's some few industry, veterans, us being two of the four of our four founders, Peter Hopper from, DH Capital and Digital Bridge, and John Chaputis, who came from GI Partners as well. And he ran Infomart before that.
Sure.
We realized that there needs to be a way to usher in that capital. And there needs to be a way to help these developers, i.e., get more capital for their unfunded development. And so we saw a perfect match there. And I'll let Bill explain. But the thesis is effectively, we're the easy button for the seller. We're the easy button for the buyer. And so by bringing that together, we're going to have the easiest way of ushering in new
Are you
capital in
introducing
an independent way.
new-
Because I left the Cyrus board. I'm completely unaffiliated.
You're no longer.
No longer affiliated. Once we started PDI, I walked away, and still fantastic relationship. But it was our thesis is we need to be independent. in order to protect the capital.
But I'm sure that if Cyrus came to you for money, no problem helping them. Just like
Well, I'm independent.
absolutely.
So,
Okay,
yeah,
that's
I'd love
right.
to, Eric. I'd love to.
Same with Digital Realty.
Right.
No kidding. So was that the plan when you guys started this? I mean, obviously that's you two, and you guys have two other huge names. So there's 4 captains of industry that came together. People that don't understand Chaputis at the time. I mean, Infomart they're the 1 million square feet under one roof. That must have been at one point the largest data center in Texas, right?
I think it is.
I think I don't know if it is now, but it had to be back
certainly.
in the day. But
I don't. Yeah, not now.
But
because
it's a major interconnection hub.
But you 4 came together. Tell us, how does that happen?
Well, I mean, those guys, even though John was an operator and he still is, like deep down,
yeah,
they had been on the capital side for the last, 4 years.
Well, that's what I'm saying. Why didn't you guys just go back to GI? That's what the genesis of where your group kind of came from at Digital, right? I mean, a lot of the GI guys.
We wanted to be independent. We wanted to create something
Another
de novo again, as I did with Digital, as Dave did with Cyrus, as Peter did with DH, and as John did with Infomart.
Mm-hmm.
There's so much demand for capital, though. A new brand to do it made it seem easier because you guys have a different purpose or a different objective.
There's nothing easy.
Yeah, starting new.
Right. I mean, we all have interesting resumes,
paper, which is good and bad.
Right.
Who started it? You guys sat down and you're like, just hear me out. I have an idea. We need 3 or 4 of us. How do you build? Like, I built a company that's primary line of business I use to generate revenue is not a building or connectivity. It is a human being, right? So staff augmentation or professional services is all we sell. And when you look at that, the optics and how I view the product are very different than certain things. And you build a company around the capabilities and limitations of that team, right? So I went out and got some founders, and they all have their abilities to do certain things, and then they have limitations. And what the company is able to offer was based on those capabilities and those limitations. For you all, were at some point, with your horsepower and your brand names, you could have done it on your own. What made you bring it all together?
We could have, but so true story. Press release comes out of Digital. Just like when his press release came out about him being CEO, press release comes out about me leaving. Within an hour, I get a call from Dave. He said, "What are you doing?" He said, "Want to have lunch?" And I said, "Yeah." And you remember this? And he said, "When?" I said, "Well, I've got plenty of room on my schedule right now. I don't know whether it's how about tomorrow at Carve over on Southwest Parkway." So we went out to lunch at Carve. We had a nice talk about things we could be doing together. And literally, I'm walking to the door of our house, and I get a call from Peter Hopper. He must have called him first. And Peter said, "What are you doing?" I said, "Well, I just had lunch with Dave, and we talked about some things." He said, "What are you thinking?" So we started, combining, thinking about it, brainstorming, and we were in brainstorming mode at that point. And but we decided, well, let's see if we can do something together, 3 of us. And then I would say, I'm not sure exactly when, but a month or 2 later, I get a call from John. He gets a call from John. John has seen Peter in New York. John was leaving GI. And he said, you should talk with Dave, and because John was coming to Austin for a UT thing, because John graduated from UT. Yep. And he said, you guys should meet up with Dave and Bill when you're there. So he saw Dave first, and he saw me, and we talked about what we thought were opportunities in the data center space. And through all that,
John had just bought some stabilized assets when he was with GI.
Yeah.
And so he saw the need.
He's on the front row.
He saw that.
Peter did too, but
Peter did too, because Peter was doing this at Digital Bridge. Mark Gansey was incredibly gracious to give Peter the green light to come work with us without,
Go start.
And and at the end of the day, they were doing this. They were at the very front end of buying some stabilized assets to get liquidity to Digital, or at the time Vantage, to allow them to have their development capital. And so, each of them did a few of these deals, and they said, this is going to accelerate on steroids.
This is potential.
The problem is Digital Bridge buying Vantage assets, Blackstone buying QTS assets. It'd be like KKR buying Cyrus assets.
When you're buying Digital Realty assets.
We said the world needs an independent fiduciary to this capital. If I give capital to you to buy something from yourself, there's something inherently conflicted. And we thought if the world had a true independent platform, they would always choose that independent platform, the seller and the capital. So, the idea was take these few data points that John and Peter as investors had, and build a platform around it. And with our relationships, knowledge, ability to pick assets, and just quite frankly, experience, we thought, well, Four's a lot of people. This needs a lot of people. This could be a very large
It
platform.
was a force multiplier. Yeah, I mean, we could all have done it on our own, but
Sure.
we felt we were more powerful as a team than going out on our own and doing it.
So what is the genesis behind this? Is PDI, for people that don't know, you guys are, what market? Is it mid-market like you're talking about? You're like, all those guys went away, you're coming back into that?
Yeah, so we're trying to be an independent off-taker of stabilized, leased, and pre-leased assets. So up in Abilene, it's a pre-leased asset, and we're bringing capital to that for Crusoe, which was a business that evolved into the space from being both an energy company and a cloud company.
That was certainly I'd call it a small cap developer before
Really?
Blue Owl put the money behind them. Now they're probably mid cap.
Yeah,
Because it's
killing
what,
it.
Blue Owl came in with $25 billion. Is that what it was?
No, so it was first 3.4, then we did another 7-ish. It'll be a $15 billion investment in Abilene from Blue Owl.
And Blue Owl's
It's about 12 today.
And Crusoe's currently in the market with I think it's a Series E financing that would give them a post-money valuation over $10 billion.
Holy smokes! Are you guys?
Maybe that's not mid cap.
Well, I don't know the difference. I don't know what it is. Small, mid, whatever's.
Yeah, it's.
I mean, Crusoe, they've grown. This is one of these new entrants that's become immediately extremely relevant with a fantastic team.
Chris Stillman's doing a podcast with us, but he's also speaking at DCAC as well, right?
Yeah, I mean,
he was your 365 guy probably when you were buying it, right?
Yeah, that's how I actually got introduced to Crusoe, was through Chris.
Yep.
Yeah, because Chris and I remained friends after the 365 main deal.
I've not met anybody who hasn't had something really positive to say about the guy. I mean, that's not as easy to come by in that space.
Chris is a straight shooter. He's genuine. He's just a good guy. But he's also a grinder. I mean, what the stuff he's and his team have been able to do over the last 12 months.
Sure.
It's
phenomenal.
It's literally, I mean, I think he calls the project up in Abilene Project Ludicrous. I think everything about what they're doing is ludicrous.
Yeah.
It literally, I thought back in the day, our speed to market and what we were doing at Cyrus was, literally the best in class as far as speed to market development.
I do think Cyrus had the.
But what Crusoe's doing right now is, it's beyond. It's almost beyond the office. I mean, there's like 5,000 people on property in Abilene, and Dolan has built a machine that is, I think it's unmatched.
And it's going into multiple locations. It's not just that location.
I think, explain to people the disparity between where you guys first started. Maybe not where Cyrus first started, but maybe where you left off with Cyrus. And obviously digital's always been a huge player on the wholesale side. But the difference between, like, would digital have ever done a program like Abilene?
No.
Why not?
Well, it certainly wouldn't.
The risk.
I think it's.
They need stabilized generating revenue.
Well, particularly today, after I left, it became a lot more risk averse. And so I think it was less willing to deploy capital and growth assets, and it was probably more interested in deleveraging.
Really?
And so the opportunity that the Crusoe guys had, I'm still a significant investor or shareholder, unit holder at Digital, but I think unfortunately it's not something that they would have pursued.
Okay.
Partially because of the size and partially because of location.
Is it that the size and location which opens up the opportunity or takes away an advantage from like a Cyrus or a Digital or maybe other more established, larger capability companies, and it makes room for, because no one really knew Crusoe. They just knew Dolan and the people in orbit with him, I think. I mean,
Jamie.
Does that make sense? I mean, like,
yeah.
I think it was a team that people knew.
I also think, what we've been sitting here talking about Crusoe, what Blue Owl has been able to do in the last 12 months is
where did they come from?
It's equally as fast. I mean, they're massive triple net lease business. They have other businesses as well. But they've come in and they finance credit. They're unbelievably disciplined. They've got their game plan. They never stray from their game plan under any condition. And they were able to deploy for the first time. I think we saw true triple net real estate capital come to the data center business.
Size.
in massive size. And
Why is
they
that?
they
What did it do
finance
to them?
credit, right? So they didn't care if it was Abilene, right? Instead of Ashburn, they were able to get a cap rate and deploy triple net capital to a triple net lease, and it fit their model perfectly. And so,
What does that mean to the industry, and what does that mean to future investors or future developers, maybe?
I'd say before, other than Hussein, right? Before now, we didn't see triple net leases in the space. I can say that for Cyrus. You might have seen some.
That's all that you saw, wasn't it?
Well, no, we were modified gross too, but I mean, as I said, we bought DuPont, and I loved the triple net model that he had.
Yeah.
And when I was at TriNet, it was a triple net lease platform. So those things are so clean. There's no leakage for the investors. All the, the tenant bears all the OpEx.
Yeah.
So that's a
It's
great,
clean.
and it's very financeable.
So where's the industry going?
I think
Hopefully triple net.
the industry is
Think
going
so?
towards real estate capital, potentially insurance capital, definitely, more, I'd say, pension and sovereign wealth capital on both the real estate and these projects.
Does that take the
become,
pressure off of like a 36-month to a 7-year? I mean, what's that?
I think these need to be 15-year plus leases.
Yeah.
I think these need to be triple net. I think these need to have investment grade credit, and there might be a little room for, one below, like CoreWeave. People are financing
but what if
CoreWeave.
it doesn't go triple net for the same reason why you were, when you were Cyrus, the reason why you weren't buying buildings is because you didn't have the money to do it. It was easier to service a lease, so to speak. What if there's people that just can't afford to go triple net?
No, I think, what we're seeing is investment grade tenants who are used to triple net, and they're also operating these facilities. So
Yeah, they're
it's
seeing
different.
They're seeing them now. I mean, I think, yeah, the hyperscalers need capacity, right? They have these core business needs for AI and cloud, and they need physical data center capacity. And I think they understand, we're going to have to partner with these developers in order to get this capacity built. And one of the ways they partner is to create financeable documents, financeable leases.
Oh, gotcha. They're making
And the
it
triple
easy.
net is financeable. It's not only a cost of capital issue, just as I said about investment grade, it's an availability of capital. And it just increases the amount of capital available if they're willing to sign triple net leases.
So that's how you get the $2 trillion into the space that you're talking about.
I think that's how you get it. I don't think you can get it without that. And I don't think you can get the debt needed without investment grade and without financeable leases. So it's not just equity.
How are you
it's
changing the
debt.
psychology of how people approach this then? How do you teach
I think
them?
it was someone had to make a change, and I think this first lease in Abilene and at scale has created a model. And I think what the investment community has basically said is both equity and debt is this is what it's going to take to get us to come in and this kind of magnitude of capital, quantum of capital. Quite
So for
frankly.
these
Blue Owl
deals,
wouldn't have done a modified gross deal.
who
No.
wouldn't have?
Blue Owl.
No,
They're a triple net shop. They've got $15 billion available for this project, but it has to be triple net lease.
and it has to be X amount of years or longer of term. So
15 years.
once again,
So
they
that'll
have to
change.
be highly, you've got a highly disciplined real estate investment community. And quite frankly, the leases are going to have to conform to the capital, or they're just not going to get done. That we've never seen, multi-billion, like you don't see couple $100 million data center deal anymore. Like, everything starts with a B.
Yes.
Like
Same with
everything.
you don't see
I think
the projects are starting with
non-real estate. I heard the statistic. I don't know if it's true, but I heard that last year in the United States, non-data center, there were only 8 transactions $1 billion or more in the entire United States.
non-data.
Non-data center. And yet, you don't see a data center deal below $1 billion, like ever.
So what do you tell people about this industry? Like when you're talking to people and they're like, what do you guys do? What do you tell them?
I mean, look, I directed both my sons into the data center business. It's the future. The growth is huge. My youngest is working for DPR. He's working the Skybox deal out in Hutto.
Nice.
For Prologix and in Skybox and Google. And that the middle one was working for Rosen up in Portland.
Oh, nice.
So it's
fastest way through becoming a millionaire, they say today, is through the trades, right? I mean, there's so much pent up demand. I mean, Abilene will have 9,000 people when it's all
I
rolling.
think you're in the best spot ever. And I've been telling you this for a long time. Everyone talks about the shortage of capital. First, they talk about the shortage of power. I think the shortage of labor
talent
is the biggest problem we have in spades. I think energy will figure out a way to solve the problem. We're seeing now
You solve the
at
people,
conferences
they'll solve
more
the
people
energy.
from Houston than we see from Silicon Valley, right? So the energy community is awake. They will figure this out. The capital community is awake. They will figure this out. I don't know how to figure out the labor. That's for you to figure out, but I do think that is going to be the biggest bottleneck. If you look out over 10 years, I think we're going to always continue to wake up where skilled labor is our biggest challenge.
You need to create a pipeline. You need to train the young people to go into the space. And it's if you think about it, what we were and what we've become and what the future is, that the talent requirements at all levels, by the way, it's not just trades, but it's management in the company, CEOs, everything's, there's just not enough talent for what the requirements are.
I haven't looked at the all levels part. So that's an interesting part because I focus so hard on, I call it black collar. Everyone here at Overwatch wears black t-shirts, but blue collar, right? Because we look at it as a majority of the jobs, a little history on the fifth industrial revolution, right? When we did the third industrial revolution, started in 1969, when we really started outsourcing a lot of our manufacturing components, we outsourced so much of it to a small patch of the earth that represents 2/3 of the world's population between India and China. And it has about 75% of the world's manufacturing, and it represents more than about 80% of the world's pollution. It's the most deregulated part of the world, whereas like Europe is the most regulated, and then there's America, which is right in the middle, like Goldilocks, right? So, that regulation is what strangles their innovation over in Europe, and a lack of regulation is what really makes it challenging for us to continue to operate the way we do. So we're bringing a lot of manufacturing back to the States. The most important thing I think to manufacture today is data centers, right? And I think it's not just for we and the products that consumers from cloud or us, with the eyeball content and video caching that we drive. I think it's really focused more on national security and intelligence, right? And when you look at AI, people would say the existential threat to this industry right now is people and power, and energy in terms of that power is really, I don't think that's the threat either. We're learning a lot of stuff. I'm learning buckets right now about what we're doing in the basins in the United States, but where we're at on renewables or natural gas, I could tell you where we're at on nuclear. The U.S. Navy has almost a 77-year-old nuclear Navy, right? So fission and fusion have been around for a bit. They're not new applications of technology, and the military itself has probably 40 different nuclear reactor and propulsion systems that they could pull from a technology basis. SMRs are very prevalent. We have 200,000 people leave the military every year. That's about, I'd say that you have people coming out of the military that have been exposed to some of the most advanced weapons, machine, and tech that can apply those skills. I came from the submarine community, and it seemed to be a stepping stone to get into this industry, right? And there's a lot of former military that find themselves here, but it's not really a roadmap to get here. I'm painting with a lot of broad strokes here, but as I zoom out even further as I talk, I really think that we gutted the middle class when we started outsourcing so much manufacturing, which was a little offset to a lot of pollution. The manufacturing that's coming back is going to offer a lot of blue collar opportunities to people that they could become. It's building back the middle class. Data centers will transform humanity in a way that we haven't seen since powered flight, because it'll create jobs that turn college degrees into taxi medallions. And I have 3 kids in Division I college right now, but I'm not sending them there to go get a skill that's going to be outdated by the time they graduate from technology. They're learning business and finance, and they're learning those constructs that won't change or evolve, although the application of technology will continue to shift. I think that the way that you guys are describing the way that money's introduced to the space will have a profound impact on our industry, because it'll lead to a mainstream tipping point. Bellotti was the first one to tell me to make an industry mainstream, it needs regulation, it needs governance, but most importantly, it needs ethics. And finance is one of those things that rolls out and implements that. Once you define, everything begins and ends in finance with what we're doing. If we're not giving you money unless we're going to get a return on that investment, are we? Right? So we have to go demonstrate those things. Even me, the culture I build may be the backbone of this business, but the clients and those that that we serve is the life's blood, and there will always be, a slave and a master sort of experience, right? I think that this industry is going to change, and you guys are helping us understand the way the industry started and how it's evolved and how finance and the need for capital is shifting the way that people are going out and delivering at these scales is because they're aligning it from the beginning of what the finance industry says, this is what I need to deploy large volumes of capital. So people need to make purchasing decisions that fall in line with this. And we're feeling that ripple effect all the way down to the means and methods and how we deliver the product now. Do you agree? And do you see it?
I agree. And I mean, Bill can tell you his experience. My experience at Cyrus, back in the day was if you didn't have Blake and Nicole and Hadassah and Caroline in front of a customer trying to convince them of something they've never heard of or they don't really understand.
Yeah, the product didn't exist yet.
We are in front of these massive investors every day.
But are they sophisticated and under the teeth?
They're
because back then you probably had to educate them.
They're
right?
sophisticated, but we spend as much time explaining the basics to these investors. And we did it. We've already done it twice today, Bill and I, with some of the world's largest investors, where we've spent time explaining to them in granular detail why this might be a safe place to put capital. As Blake and Nicole and Caroline and Hadassah and
they were selling
Kenneth
things that
Wolverson,
didn't exist yet.
They're explaining to the CIO of ABC Energy Company why this is a safe thing to do. We are over here doing the same thing at a granular level. Like you should hear Bill try to explain to, ABC Sovereign Wealth Company why they need to deploy multi-billion dollars into a platform. The same way we were trying to, or that the team was trying to explain to, a large energy company. Back then we were doing, ground up deals, right? Digital was buying assets and then doing organic growth within them. But we are on the front end selling today, no different than the Blakester was out there, building a brand for CyrusOne.
Sure.
And I find ourselves back in that same place where Bill has to explain to, an associate from a sovereign wealth firm why a building in Ashburn might be more relevant than a building in Sweetwater, Texas or something. So we're still back to that, explaining these nuances to people who are looking at doing something they haven't done yet. And I'll tell you from an organic perspective, if you don't have that level of gravitas that like Bill has with these investors, you don't get the audience. So I think we're in that scenario, same place we were at 20 years ago, just at a different level, different scale, and different sales pitch, if you will.
It's funny. When we went public in 2004, we didn't talk about this. The biggest issue that the REIT investors had to get their head around was residual value. What were these buildings worth if they weren't going to be data centers? What's the terminal value of the assets? In the case of in 2004, it's like, well, what happens if they're not data centers? What can they become?
Oh, that was a big fear.
Warehouses. What do you do with all that expensive gear?
It's a really expensive warehouse then.
Yeah, it's a very expensive. So yeah, that was the doomsday view. But back to what you were saying about Christian Bellotti and his points. The one word that I didn't like that you were mentioning was regulation.
Oh, there you go.
Regulation. I think regulation is something to be avoided at all costs.
Well, I think that's the whole point. We've been trying to self-regulate, since the beginning of time. Uptime is coming
That's
out.
fine.
Yeah.
That's fine. But government regulation?
The market regulates you.
Yeah.
Okay, so I'm with you, but don't you feel like before this industry does, you don't think that before we become mainstream to where it's just as prevalent of an industry as manufacturing, retail, automotive, or energy, before that happens, there'll be something that comes in and says, you may need to settle on something as simple as an asset class. If you're in the automobile industry, they're probably, go ahead.
I think we need to be good community members. Data centers need to be assets to the grid, not liabilities. And we need to proactively do that to get the community comfortable that at 4:00 in August in Texas, if they've got a problem, we're going to go to genset or backup or whatever it is. And we're going to give you your
Give
power.
you back the power.
We're going to be contributors and assets to the community. We need to self-regulate that before the government comes in and says,
So how do we do that?
We're doing it. We're doing it today. The conversations we're having with power providers and utilities, we're doing it I know at least I can speak to, my old company has been a good partner to the community everywhere they've been, and they continue to do that. I
So
know
that is
Digital has.
that is a big threat to us, though. How have you dealt with that? The NIMBY stuff. Like, I think it's just a lot of people that don't understand the opportunities. I think that we struggle, just like you're talking to. It sounds like associates at sovereign wealth funds about the basics of the mechanics of why this is a great asset class. I'm stunned at how far we still have to go to explain what this industry is and how it impacts the communities that we sit in or operate or live in, the society overall, or humanity in the long term, right? So it's it'll be nice when we are mainstream, quote unquote, where people have some sort of understanding of what this industry does. Because today, like I said, what do you tell people you do for a living? I mean,
Data centers.
and when they say, "What is that?" What do you say?
Well, now if they read the papers,
Yeah.
I'd say every other day there's an article in the Wall Street Journal about data centers, and some good, some bad. But
Well, the bad stuff is the part that we have to focus on, right? Because
the bad is the drain on the electrical grid, I'd say.
I think, look, when Gary and the team were out there doing the IPO roadshow, I remember the pitch to creditor, everybody, that this is all IT is going to be purchased as a utility one day. And while 100 years ago everybody had a little generator in their backyard, now we buy from the grid.
it is.
And we're there. Right. So the view they painted on their roadshow is living proof today that we're there. So now,
I remember
as part of that grid, we need to be partners with the grid and not be, just
Takers.
Takers.
Well, the data center is the fifth utility, right? So the first one was water. Plumbing was the first utility ever introduced to a home. Ironically enough, do you know how long it took before 1 in 4 Americans put electricity in their home from the time that it was introduced to society? 46 years. The third utility was connectivity. Right, so Ma Bell and a wire, right, just a piece of copper. You know how long it took before 1 in 4 Americans put that in their home? 27 years, right? So, I mean, we could go down how fast the adoption rate of emerging technology goes until you get to, I mean, Facebook probably took 3 years. WhatsApp 100, 1 year. Chat GPT 5 days, but it took TikTok 9 months, probably, right? So, like, we adopt stuff faster but there's a lot of things that evolve. The faster we adopt it, actually, the faster we can break the bad habit of whatever it is that we have. Things are changing. The industry changes. The adoption rate of emerging technology is changing. So when you guys are, shifting back to what you're doing, you're saying, look, there's so much pent up demand in this industry for more volume and velocity of data centers. And what we have is a bunch of people that have money and they want to put it in this space, but they don't know how.
Exactly.
So now you have a bunch of people that are armed to the teeth and they're pretty sophisticated as developers or enterprise end users. And they would like to make a purchasing decision, but they're asking something of an operator or a developer that they can't do. So the developer says, if you sign a lease based like this or a contract based like this, triple net instead of modified gross as an example, then we could turn on access to that capital. And you guys are saying that your job is to go in and analyze the market trends and then see where the demand for capital is and then come in with legal and financial constructs that free up. It's like you're taking kinks out of hoses that take the money from the markets and bring them into this industry, which enables and allows that growth. I'm in parallel to you because you could put all the money in the world in that space, but if we don't have human brains, if we don't have people that could put fog on a mirror every morning, then we're not going to deliver any of these things, right? And for me, I had to go create a university. Like I did it just for my own team. Where, I bought a company that has one of the best. My chief talent officer is a former tier 1 Navy SEAL operator at the highest level in the military, and he's ranked number 9 in the world right now for leadership gurus. So we use him to define how he teaches our teams how to lead themselves, because they have to show that they could demonstrate that before we could teach them how to lead others. So I'm trying to get caught up to you as you're struggling to find the money and to bring the money in. And now there's people like, I have the money, I have the construct, I have this. But I can't make it happen fast enough. I can't get enough humans. Abilene's a great example. There's other markets, as I know that you guys know too, there's
the announcements in the last month of these gigascale, Advantage just announced.
Got to get humans.
There's, we're going to see a few more announcements of leases signed that are more than a gigawatt. I don't know where the people are coming from.
Well, we're trying to get them.
And what's out of all of our control.
We're getting phone calls. It used to be, hey, I need 2 or 3 people, because I'm not like, there's 5 phases of the data center life cycle. The very last phase is operations. And there's groups like Salute and other groups out there that do that. But if you look at it, I mean, even at digital, even at CyrusOne, how many pennies for every dollar is spent on operations? Well, Nirvana would be 10 cents for every dollar, right? But it's probably 10, 15 points, 12 points, depending on P. But even then, if you cut that in half that's utility. The other half is the HR. I mean, that's the payroll and HR. And that's a very small number. For us on delivery, 80 to 84 cents in phase 3 of this market is where 80 to 84 cents is deployed in every dollar. And that's on CapEx. Humans that can build these things are hard to come by, and those are what we're trying to teach. The operators is different. If you could build it, then you could operate it. But just because you know how to operate it doesn't know that you can't go backwards into building. It's like when you bought Telex, faster way to go into the retail market than to try to start a new retail market with a completely different business model that had a CyrusOne, high volume, high touch. Like Cyrus was designed from a service basis to be able to service 1,000 tickets a day, where if digital had 1 or 2 clients under one roof, that would have been challenging, right? Different business model. The whole thing is shifting from humans, and we're just trying to figure out how do we convert people and get them into the market. And it's really like any other trade. To be able to solve the labor crisis, which is more than 500,000 people right now in this space, we have to almost unionize a skilled professional craftsman team of labor that is almost like a union trade, but doesn't have a union like protection model, right? The means and methods and how we build these things. Think about it, how they are when you started. The product isn't even close to the same when you guys started, right?
No. And by the way, in 5 years, it'll be different than we see today.
Well, it might, but I push and I challenge you both back and be like, at some point, even the automobile industry stopped and said, all right, let's define asset classes. There's cars and there's trucks and there's vans. And I mean, but there's certain different types, mid-size, full-size. We got to the point where we have to code lock some shit. I mean, the soup has to be done cooking so we can standardize on, the whole product that we sell today is speed and volume. Do you agree?
You react to us, or to the developers, I should say. We react to the demand for capital, but we're all reacting to the chip. And at the end of the day, it's out of our control. We didn't know when the blade server was going to show up compared to the pizza box.
But
we
it's
don't know
integrated
when
now.
a megawatt in a rack, which we hear is coming. And very, very
There's
soon.
a whole model, the 800 volt DC shift.
That's right. Too, so right? The block size has changed overnight, which reacted to the show. At the end of the day, what's out of all of our control, at least in this conversation, or if you were to throw a developer in the room, is the technology that's driving all of it.
Yeah.
And so, ultimately that's the gating factor.
But now we are actually having conversations where like Wade Vincent will be speaking. I know you're speaking to DC. He's the one that they've kind of said, like, if you want an NVIDIA solution to go into that building, have Wade take a look at it and do Caesar or, do one of those things because he'll be able to tell you if it's future-proofed enough, so to speak, for it to evolve and grow. Because that's what you're saying is we haven't arrived where we understand where the final will we stop at a megawatt per rack?
I mean, no way.
You don't think so? I think
I'm shocked we're anywhere near that. So no, I don't believe we stopped there because I can't even believe we're here where we are.
I think that there will be something that I could tell you it's untenable if we don't stop at something like that unless we have a completely different conversion method from a economic pivot on how we can't use this fossil fuel and renewable energy solutions that we are using today to solve for that volume and velocity of energy, the densities that come from nuclear.
Well, that is the issue, but
yeah, but the issue to power is still not power. We could create power. What I was saying is, I mean, we're flaring gigawatts in the Permian Basin of natural gas every day, right? So, in fact, they have a dyslexic dichotomy to us in the sense that, in the Permian Basin, it averages 4 barrels of water for every barrel of oil comes out. So, the Permian Basin is well known for having a little bit of oil and a shit ton of water. And if they don't find source uses for that water by 2030, then they're going to have to stop drilling. Seems like a very appropriate place for us to put. If you're running 1.5 million gallons in a closed loop system on a daily basis of water, treated water, which is recycled and desalinated, which we can use from them, seems, if you could get it to pencil out, it seems like it'd be a really good solution to offset our water demands, because that goes back to the optics of the NIMBY optics. Like, I don't know if we're really hurting the grid from an energy perspective because we're going to build so much behind the meter shit that we could go close transition and put more power on the grid. especially in deregulated markets like Texas. But on water, that's a completely different. People are worried that a 100 megawatt data center requires the same amount of water that could traditionally be used in a city with 30 to 50,000 people on a daily basis. That used to be the optics. Now, obviously, with hybrid mechanical solutions, we're shifting,
Right.
and the demand of water is obviously way more efficient than what it ever was. But the volume and velocity that we're doing, they don't realize that we're pulling water out of the rate table when we're pulling out oil, and that water isn't the potable water that we're drawing from, is what I'm saying. So we have to figure out how to paint a better narrative and a better optic for people in the communities that want to have a higher adoption rate to what we're trying to push, right? Because I do believe it's offering incredible jobs and incredible careers, sustainable careers. Think about Abilene. Construction projects weren't as much fun. People wanted the OpEx projects for operations because you can sign a 3-year contract with CyrusOne, and that looks great. But I'm like, what if I go out and I build in a market where I'm going to have 5,000 people in Abilene, up to 9,000 people when I'm done? That's an entire city or village, and they'll be there for 3 to 5 to 7 years.
Look,
and the scale of these programs that we're building are only getting bigger. So I'm not a labor force now. More, I'm like a coal miner, which the coal mines themselves own the town. They didn't just have the labor; they own the houses and the stores and stuff. And that's what I have to get to. That's where we're at.
And it's look, the data's going to the power. We all know. But the problem is the infrastructure around these power doesn't exist. There's no hotels. There's not enough restaurants.
Yeah, that's why
So if you're a traditional real estate developer and you say, okay, like let's run a market study to determine if this town can support this development, the answer is always going to be no.
Yeah.
I mean, even Abilene, it's just a bigger town. Amarillo would be fine. You get out to some of these other towns where they're going to be bringing these projects.
Now we're building campus,
and we're going to build man camps, but we need more permanent infrastructure.
Just
permanent infrastructure, because the labor that you need to manage these chips, we're just talking about the tenant. Once it's there, the people they have in there, it's different. They need permanent infrastructure. So I think we're going to see the evolution and the growth of a lot of towns that we'd never heard of. Just like,
that don't,
when Dominion fell apart or stopped delivering power, we saw New Albany show up.
Yeah.
Like Columbus, Ohio.
Manassas.
Who would have ever thought of that?
You guys were doing
right?
big moves in Manassas first, probably, right?
There's, some people I've heard say that, Texas is going to be bigger than Ashburn at some point. Now, it's hard for any of us.
West Texas.
It will.
It's hard for any of us to envision that because, add up all the data center, markets in the country, multiply by 3 and you get Ashburn. So how is Texas going to be
about
great?
7 gigs, right? Oh, no, I'm sorry. Ashburn's about 6 to 7 gigs right now, right? So let's say we're at 40 gigs in the U.S. The biggest concentration in the world is no doubt Ashburn.
Right.
But how many programs have a gigawatt to them that I know that you guys are aware of, the same ones that we're tracking, right? Because you guys are spearheading the money behind half of these programs that we're seen as a byproduct of that. The sky for the cloud is no doubt Northern Virginia, but the home for AI will be Texas. It seems like there's that triangle between
I think Pennsylvania had their big announcement.
Western PA.
Western PA,
no doubt. And it has its own basin up there too, right? And and they have
Marcellus, yeah.
They also have their own reactor up there with that one program that they were doing, right? And I think though I didn't know this until I did a lot of research, that Texas has more renewable resources than both Alaska and Montana. And I think that you'll see is, according to Goldman Sachs, we'll be putting 45 gigs of renewable on the grid between now and 2030. 60% of that, or 27 gigs alone, will just be natural gas, and we have a shit ton of it here in Texas that could be used. Not that you can't get it there, but the reason why Texas will win is because it has 116 undergraduate educational platforms and 15 military bases, 2 of which are some of the biggest in the United States. So it has a much larger talent base to pull from than the state of Pennsylvania.
I think it's in the regulatory environment, at least today, it's
100%.
really favorable. So
yep.
We can't let that change, by the way.
And there's no state. I mean, if you use the fiber backbone using the hub and spoke of the U.S. railway system, there's 8.2% of the U.S. fiber is just in the state of Texas, right? So just because you have so much railway line, right? So there's so much that could be benefited from here, including the basin, including all the energy and natural gas and water and things that we could find. I think that what we have to do is, we're seeing the changes that you guys are talking about because we're having conversations. You may have been the one that mentioned it, is like the more open transparency that these partners and teams have with each other, instead of like a vendor supplier relationship, now they're in full collaboration with each other. Because like I have to do it on labor. Look, 4 of my top 5 biggest clients by the end of this year will be hyperscalers. But that means the operators are right there behind them. And 50% of my work are the operators. Those operators don't call us anymore and ask for, I need 2 or 3 people for a project for the next. I need 40 people I need 32 people in the next 4 months to get started. And I'm going to need 12 people every month until we get up to whatever, right? And these programs will ramp for the next 3 years. I'll put in, there's programs where I could tell you I'm staring down the barrel of that I may have 60 people on that program. I'll put another 60 on it in the next whatever. That is a complete shift. And I'm sure it's something that you guys saw too when the market was really evolving, because you were dealing with the infrastructure first. First ones through the wall are always the bloodiest. But on labor, I trail behind it. But now the tail wags the dog, where there's programs that they're like, unless we could get the labor, we can't even start this program. So a lot of these programs, and that's because the labor is required for power, distributed natural gas generation plants. So they're looking for the labor force that can do that as well. The product used to be 4 walls and a roof. Now it's, I need the energy that goes with it because I'm going behind the meter, right? So labor is the solution for energy, is what I'm saying. If we could harvest people coming out of the military, that's all they do is go out to places where they build islands of power to support mission critical. The military doesn't measure the mission critical on mortality. I mean, on downtime, it's measured on mortality instead, but they still have that experience. Guys that have Air Force Power Gen Pro backgrounds, the Army Corps engineers have incredible backgrounds for power. The nuclear community in the military has some background experience as well, but we can do this. Like, we can put the power on to be aligned to your guys' ability to put capital in the market fast enough. But right now, think of where the money, everything begins and ends with finance. So if it begins with you guys, there's 40 kinks in the hose before it gets down to labor. Does that make sense?
It does. And I think just like you have a decent idea of how you could grow your labor force and how quickly you could grow it, we have a decent idea of how we believe we can usher capital independently into these platforms. But the pace is picking up faster than any of us expect. And so, the pressure on the developers, like take Chris Crosby. Chris Crosby has an incredible, repetitive, amazing business. Like they're super disciplined. They know exactly what they're focused on. They're probably more focused on saying no right now than saying yes. And that's where I think the discipline, because the pace, no one has a chance to make a mistake. These are mission critical. That's the whole point.
Sure.
So you can't miss. We can't miss with capital. You can't not show up. And, ultimately these developer operators can't just fail. So everybody's throttling right now. And the question is, how do we open those throttles up?
What is the biggest challenge you face? Because we'll start breaking this podcast home. I know we've been sitting here for a long time, but this is an important one. I told you I wanted to go a little deeper in the paint on this one, just because there's a lot of pieces here where people don't know. A lot of people know where we're going because they don't know where we started, and they don't understand the linear trending. Like if you started from here in 2000, you put a dot here and you started looking at things, you could kind of see these patterns that go like this, right? And right now, we go so fast and then we slow down, and we go fast and then we slow down to like kind of fix or correct. And right now, what are the things that we're solving for? What are the biggest gaps or solutions of opportunity that you see that are going to be fixed from a finance basis that allow us to open up speed?
Finding enough capital for the opportunity.
Is it not sitting on the
opportunities
sidelines?
right that we're seeing right now? We've got to make sure that we get the capital to face off against those opportunities.
And is it because there's not a lot of people that could come in at this volume?
There's not a lot of people that can come in. There are disciplines in the capital markets, just like there's disciplines in the operators. And quite frankly, I feel like we're in the same place we were 20 years ago. We're educating. This market's grown. 20 years ago, nobody knew what we did. 10 years ago, nobody knew what we did. As far as the nobody.
Yeah, you're right.
We are in the process on our front, in our business, of educating people. Everyone's heard of data center. Everybody hears of AI. But how do you translate that to a secure, conservative, safe investment? Our job is to educate.
I have to educate, but not on an investment, on a career.
So we are out on the front lines talking to massive pools of capital that understand what a toll road is. They understand what airports are. They understand what, industrial buildings are. But these data centers are beasts. They're living, breathing, changing machines. They're not just warehouses, and they're
So
not
what
just
is their
toll
biggest
roads.
concern?
Risk.
Are they worried that like
Risk.
AI is going to slow
What
down?
changes?
Obsolescence. I'd say.
Obsolescence
The obsolescence of AI?
of the asset.
Of the asset. Terminal value.
So is there something that they've seen in the last, let's just say arbitrarily 20 years, right? So let's say some people think this industry began when Amazon.com went live in 94. So let's say we're 31 years old, knowing that it took 47 years or 46 years for electricity to be adopted by 1 in 4 to become mainstream, and 27 years for connectivity to be adopted by 1 in 4 Americans to be mainstream. Let's say, the fourth utility was gas. And if you add up the first 4 utilities, water, electricity, and everything else, you're going to have to sit close to your mic, Bill. If you look all those things up, if you add up water, electricity, connectivity, and gas, it creates the fifth utility. We buy cloud as utility today. Everyone buys cloud services. It's a utility already. When you see these changes coming, are the shift in optics and how we view these things, I don't know. I'm wondering what that means to the investors. Are they becoming, when you guys are talking about your investors, I'm like, are they getting more armed to the teeth? Are they becoming more knowledgeable that you're dealing with it? Are you constantly just educating a brand new audience of investors first?
Well, I think that with the power densities, the technologies are changing inside the building. So the question is whether the older data centers whether they'll still be valuable, or if not, how much capital investment will have to occur in the older buildings to make them relevant to the new requirements.
That's no doubt. When all the AI greenfields slow down, we will go back and start modifying the other 40 gigawatts of data center. Every data center that we've built since 94 to now, let's say 31 years, every one of those will at one point have to be retrofitted back to be able to support the mechanical densities of an AI.
And is it economically viable to do that?
Well, if not, then what's the option to shift it more to an AI factory from a data center?
That's what we have to educate the investor on. If you sign a 15-year lease, what happens in year 16?
Yeah, who's to say that the stuff that's being done today isn't going to end up where the stuff that was done 15 years ago looks today?
So that's why I was asking, have we seen anything since 1994, in 31 years, have we seen investments to where the technology they invested into as investors has become obsolete, or data centers? I'm not familiar with a lot of data center companies that are failing in this space because they don't.
I haven't seen a lot of buildings turn up. I think that
that's what I'm saying.
The use case changes.
So that fear seems misplaced is what I'm saying.
I know. I mean, you actually see tape drive applications that are still in use.
I heard that 70% of all compute is still on-prem. Have you heard that?
Yes.
Isn't that bananas? So out of all the growth we've seen in the industry, that's to get 30% of the world into cloud. And that's how busy we are.
And by the way, the cloud, one thing we haven't even talked about, we talked about AI today and we won't get into it now, but the cloud's growing at Microsoft. I think Azure announced a 35% compounding annual growth rate. So that means every 3 years in those cloud markets, they need double the capacity.
And
in every 6 years, they need 4x the capacity that we have sitting today right now. We know the utility can't provide it. So, we've got scarcity everywhere. And I think one thing the capital doesn't want to wake up to is my building's obsolete. I think we're really safe right now where we are, but convincing them of that takes a little time.
Yeah, these are the late movers that we're dealing with.
Yeah, the late boomers, you said?
The late movers.
The movers, yeah.
Late movers into the space. They don't want to be the suckers.
Well, what's crazy for me is I was reading a report that said of the 10 gigs that we're in construction with right now, 7 gigs will come online this year. And 93% of the 10 gigs that we are in the motion of building have already been pre-leased. So we can't keep up with demand right now because you guys can't go get money for the industry. I don't know why you guys are holding us all back. It's not labor. I got that on lockdown. So it's just
capital's tight. Powers.
Is it really?
Believe it or not, I think the capital at this scale is very, very, very risk averse. And so how do you make sure that the application, the location, the lease terms, et cetera, are going to protect the capital? And that's quite frankly,
it's benefited us on labor because people that don't have the ability to write those massive checks are like, we want to be in the game, but we can't be on the asset side because those are huge checks and we don't write those. So maybe there's something in services. So now you have a lot of those companies that are like, I want to invest. There's a lot of growth. Maybe assets in it, services is it. So for us, it's benefited us because it's brought a lot of people that want to be in the game but don't have the ability to write checks.
Write the big check, right?
Does that make sense?
It does.
I didn't realize, but you guys are probably, I have to imagine there's less than 100 people, 100 firms on this planet that could probably feed the criteria of what you're looking for volume.
Far less.
Yeah. That makes sense. What a small industry. So I can go for another hour, but I also know that I'm sensitive to how much we're going to unpackage, and I'm not going to unpackage it all right now. Hopefully, this is maybe the first one I get to do with you guys now. You guys are both unicorns. Getting you guys on this thing, it would have been easier to get the Pope to be on this thing, probably, right? But you guys,
no, he's from Chicago,
and you guys don't like talking about this stuff, and that I appreciate you doing it because my objective was my objective was to memorialize where this industry began with two of the guys that helped build this industry. So for people that are listening, you guys were at ground zero for Cyrus, ground zero for digital. And those two companies, since I've been here, I don't care what you guys would say because you guys are on the inside looking out from the outside looking in. I got to have a spectator seat, meaning I got to see digital change the entire industry. And then when I do believe they shifted their approach to it to a way that was more just REIT focused, I saw Cyrus evolve to try to pick up in an area that I felt was underserved on services. And that's what Hayden and Tesh did a good job of doing the whole shake and bake. Tesh could sell anything and John and his team felt like they could deliver anything. And they had to challenge the market in many ways, but I think that there's other companies that have been very transformative to the industry as well. And we're going to be bringing some of them on, but I wanted people to hear where the industry began with you guys. And then where it's going is the buildings are just getting bigger and the programs and the scopes are just getting larger. For me on the construction side, it takes pressure off of us because to build a data center, I mean, when Cyrus was rolling and digital was rolling, if they outsourced any of their work, if Anthony was outsourcing, he'd be like, it's for this one project for 9 months and then we're done, right? You can't get away. You're not building Abilene without 7,000 contractors. You know what I'm saying? You just need too many people at every altitude and airspeed, from Oracle to all the way down, DPR, Rose. They all need massive volumes of talent, right?
Yep.
So, and it's not because they're 6 month or 12 month contracts. These programs are for 3 to 5 to 7 years in some of these programs we're looking at.
And
right?
pay attention. I mean, if you would have told me 4 years ago that there was going to be the emergence of all new providers like Crusoe's,
yes,
Core Weaves of the world,
Bill Streets, how many companies have stepped out? And
yeah, I mean, I would have said it's too late. You need to have an embedded experience platform like a Digital or Cyrus or Vantage or something. But they're here and they're changing everything. And,
3 years ago, would you have predicted that QTS has achieved the size that it has?
No, I think kudos to Blackstone for coming in and really just empowering that team,
rocket fuel in them,
and letting them run, and really becoming a partner to them. I mean, just like, quite frankly, I've seen the sponsors at CyrusOne be fantastic, partners to help them accelerate. And just like, quite frankly, if you look at what Digital Bridge has done with all their platforms,
oh my Lord,
Vantage and Switch and data,
it's amazing.
Zcolo,
these are partnerships.
Yeah.
These aren't just like investors and investing in some operators and leaving them alone. These are
Is Faust the chairman of all their boards or something? Is he like
he's chairman of DataBank, right?
Chairman of DataBank. I don't know if he's involved anywhere else.
I got you. Well, I mean, this has been great. I mean, what didn't I ask you? I know I didn't even go to the paper in which there was all kinds of questions on here because we were addressing some of that stuff tangentially as we were going through it. But what didn't I ask that you think is really important for people that are listening? Because some podcasts, like this is not one to entertain. This is not even one to really truly inspire. This is one to educate people. I'm hoping that people will reference this when they're writing college papers and they're representing you guys, what they've learned about this industry. But what is it that you would share with people, either people that want to go build their careers in here, if you liked it enough to put your kids into the space, but what do you want to leave with people that I didn't ask that would want to as an investor or just as a brand new person emerging that's looking for a place to
There's no higher growth sector out there today. There's no higher growth sector.
There's nothing. I think that everything will be focused. I think there'll be our industry when this is all said and done as the primary industry in the world.
Yeah.
And I think adjacent to that will be in orbit a bunch of other industries that are there to support and serve the growth of this industry.
Yeah, you can invest your career or your money in things that touch it.
Right.
Businesses that touch it, and it'll benefit from the growth.
I agree.
If I were to talk to someone young today, I would say that look way beyond today and understand that your biggest competitors are going to be your friends. People matter. build bridges, literally build your networks, because the people you might think are, on the other side of a deal are going to be inside the camp, and the world gets smaller, and those relationships matter. And I tell you that we don't know where this is going, but I know that one day you're going to bump into the same people, and you want to have good relationships. You want to take the high road. You want to build, quite frankly, a network of people that you can ultimately, partner with, even if they're right now, they might seem to be your biggest competitor.
Yeah.
People on the capital side are going to be operating side. Operating side are going to be the capital side. So I'd say, focus on the human factor. People do matter. Relationships matter. Your networks matter. And think way down the road on that. And I think, when I got to know Bill, we did always consider digital our competitor, whether they consider us their competitor or not. In the boardroom, on the playing field, it didn't matter.
You had to have a competitor.
We had a competitor, but we always kept fantastic relationships with everybody we met from that group. Chris Crosby.
You need worthy rivals is really what it is. You want a rival.
Andrew Schaap has always been a friend. Sure. And he woke up being, and so I'd say that that's probably, if I were young and I were getting into my career, I would say that get out of your own head and people matter.
Yeah. The best advice one of my mentors ever gave us was, he told me, be careful the toes you step on today, because they could easily be connected to the ass you're kissing in this industry tomorrow.
That's exactly right.
Great advice, actually. So to that end, that's a good place to kind of park it. So look, I hope that I have the opportunity to bring you guys back on as the industry continues to evolve, and we could continue to unpackage how complicated this industry is. Maybe next time, instead of going a mile wide, we just go an inch wide, but maybe a mile deep, maybe down deeper on finance or whatever it is. But I think it's important for people to understand where this industry started. It started in the wild, wild west. There wasn't a lot of teams. There wasn't a lot of, there was no NFL. So you guys didn't have to find competition. You kind of had to go figure out who you'd bump into and then create a rivalry off that, and then use it to push yourself sometimes. This industry is small. It's, pent up with a ton of demand. It's lacking in a lot of human beings. More than 50% of our industry has been in this industry for more than 20 years, meaning that the silver tsunami could happen anytime. The industry, the market, the global economy can be really great. And all of a sudden there's a de-escalation in tension between wars in China and Ukraine and Israel, or who knows what happens. The next thing you know, a lot of these people that have been in this industry since the beginning of the industry retire and resign, and then what happens next? And we don't have enough people to support the demand for growth today, let alone half the industry can financially retire with some stability, right? So there's so much going on. The relationships are everything. I tell people we don't build networks anymore. That's what technology does, but we definitely have to invest more into humans. We have to build more relationships, because those are what's going to move the needle on half these programs. It's all relationship. I think this industry is heavily, heavily focused more towards relationships than it is the product itself. Do you agree?
I've always believed it.
Yeah. So, all right, Lenny, last advice before we bring this one back home, Bill.
Let's wrap it.
I know this is not what you guys wanted to do. So I appreciate you guys both coming in and making
our pleasure.
Well, you've done a great job with this. Good luck on you got a big conference in a couple of weeks.
Yeah,
I'll be there. I'm excited.
Bill, you coming to it?
I have to be in Chicago that week.
I got you. Always big.
Bill's got to get some cash.
See, like I said, getting the
trying to spend it. So.
Hey, look, it makes sense.
The money.
We're not going anywhere, but this is the first of this. Hopefully, not the last. So, guys, thank you for stopping and making the time. Salute
for having us.
Thanks, Bill. Appreciate it. Thanks for joining the revolution.